S&P futures up quite strongly. There's positive sentiment around here, and this is all coming from China, what they are doing already on the property sector in terms of stimulus and what is still to be done there. As a result, we're seeing money coming out of the US dollar into the Chinese currency and into other risk-on currencies such as the yuan. We've also seen that the pound is benefiting. That's not to do with that risk-on story, although it could be linked. It is to do with the wages data that, Stephen, you and I went through at the start of the last hour, and the wages data certainly making life difficult for the Bank of England. What do you see on futures?
We are seeing futures pointing positive into the start of the market open. The FTSE 100 only up by 0.1%. Of course, we've got that function of moving sterling as well, but much more positive moves looking on the CAC 40 futures up by 0.5%. DAX futures up by 0.7 as well. We're looking for read across, of course, from that Chinese story too. Interesting to watch chip makers too after the TSMC results that we had out of Taiwan earlier as well. To be watching to see any effect from that, Anna.
Okay, yeah, absolutely. So it's a combination of that China sentiment and TSMC. Those numbers we'll certainly watch to see if we get movement on tech stocks as a result. So we'll move on from this cross-asset check and we'll get to the start of the European equity market session. As you've been saying then, Stephen, the sentiment has been quite positive working through the Asia session into the European start of trade. And here we are, the FTSE 100 pretty flat. And this has been fairly typical. Yesterday we saw the FTSE underperforming the rest of the markets. The rest of the European markets weren't going anywhere very fast, but they certainly was a little bit more upside there. The FTSE underperforms and continues to do so today. The CAC 40 up by 0.5%. The Spanish IBEX up by 0.5%. Here's the sell-off away from the US dollar that I was mentioning earlier and going into, well, the Chinese renminbi, but also other currencies, the pound, the euro, the Australian dollar, all benefiting from the China story, perhaps, or from other factors. The pound moving as a result of that wage data, as we pointed out just before the start of trade today. Interesting to see then, Stephen, that yields are coming down because that's been such a preoccupation for markets over recent sessions. The fact that yields were going higher, there was expectation of further hiking from various central banks, and as a result, that was putting pressure on equities, weighing on risk assets. Well, we do see something different today. Yesterday, we saw the UK yield story coming lower, which is a bit of a relief for gilt, for some in the gilt market, perhaps. But then we are seeing that spreading to other parts of the world as well. So a broad buy everything theme on this morning. What do you see in sectors?
Well, let's take a look and see what people are buying. And I'm going to go straight to basic resources, up by 1.2%. So there's the China story playing out for you in terms of demand and what exactly that will mean for the performance of the world's second largest economy and the read across into those European resource companies. So we are, as Anna's saying, seeing overall positive sentiment. The FTSE underperforming there as well. Interesting to note technology shares, so 0.5% higher this morning. Of course, the read across from TSMC, one of the factors we're playing to there as well. Food shares looking a little bit weaker though. That's of course an interesting one to watch too, given the moves that we've seen in that sector in recent days too. Travel and leisure also 0.7% higher. So that is one of the better performing sectors today. Interesting to play that into, of course, the oil price moves as well that we've had too. Retailers too, 0.4% strong. We'll be watching UK retailers after we had some figures out from the British Retail Consortium on retail sales here in the UK as well. That's the picture across the sectors, the market open.
Okay, so that's what the sectors look like. Let's get to Christine Aquino joining us today from the Markets Today blog with initial reaction to what we're seeing on markets. So we see, once again, the FTSE underperforms a little bit here, Christine. So broad risk sentiment really coming through from China, but the FTSE immune, and that's really quite interesting, isn't it? Because there would have been times where that would have lifted basic resources stocks sufficiently that maybe the London market would have benefited, just like the more consumer-facing markets of France or the industrial markets of Germany, but maybe not the case today.
Absolutely, Anna, and I think the FTSE's focus really today is more the domestic story that we're seeing play out in the UK, right? I mean, of course, we saw the labor market data really surprising to the upside, especially when it comes to wage growth, and that's kind of fueling fueling all these worries about what potentially more Bank of England rate hikes will eventually do to the economy. And I think that is kind of investors looking ahead beyond the 6 months or so where we are pricing in the peak of the Bank of England rate to be at 6.5%. That would be, what, a 25-year high? So that is quite a major moment and potentially something quite negative in terms of economic implications for the UK.
Yeah, of course, we had the commentary too from 3 Fed speakers yesterday talking about more rate hikes, 2 more rate increases, Mary Daly among those who's pushing in that direction as well. Talk to us about, I suppose, where we're seeing the reaction to that through markets.
Well, Stephen, quite interesting because we did get a few Fed speakers arguing for more rate hikes, but then one notable dissenter, right, Raphael Bostic, and that really just speaks to, even at the Fed's level, you know, the committee itself disagreeing over where the path of U.S. rates will go next, and that's exactly what we're seeing in markets as well. There's kind of a lot of confusion at the moment where the Fed path is going to go. The short end part of the market, of course, the more sensitive part of the market to interest rate expectations, still being anchored by those rate hike bets for the Fed, but then also we're seeing yields on the longer end higher, and that's more sensitive to kind of expectations for the economy and inflation longer term. So perhaps this is investors saying that maybe inflation at this level will be here to stay for longer.
So that's the inflation story and the Fed speak we've heard. We've also heard a lot from China. We've heard about support for the property sector or an encouragement by financial regulators in China that banks should extend the provision, the help they've been giving to the property sector. But then there's an expectation that maybe we get more. I mean, this is a story that sort of keeps delivering, but at the same time fails to deliver because it seems to come in small bursts as opposed to sort of one big market move. Maybe that's sensible.
Yeah, absolutely, Anna. I mean, you do definitely get the sense that the Chinese government trying to keep its powder dry as much as possible before they really wheel out the big bazooka of stimulus, right? And so that's what we've seen so far. It's kind of a drip feed of support for the economy for certain sectors. The property one in particular, very prominently, especially because over the last few years, China had tried to move away from property-driven growth, but now they're trying to get back into it. But yes, I mean, even just the expectation of potentially more coming down the pipeline and something more comprehensive from the Chinese government, definitely enough to buoy sentiment this morning.
Okay, Christina Kino from our Markets Today team, thank you very much for joining us. You can get more from the team on the front page of the Bloomberg UK website or by typing TLive on the terminal as well.
Okay, let's in a moment get to the individual stocks that we're watching this morning. We'll get a breakdown of how some of those have been performing. Let me just recap what we see on the sector perspective, though, because this is interesting. Stephen, we just see the FTSE 100 dragging into positive territory, and this is to just where we started that conversation with Christine. It's relevant because basic resources is the best performing sector this morning. That is that read across from China and the property sector, the level of support it's getting there, and it is finally pushing the FTSE into positive territory, although just as I'm speaking, it's dropping back down into the red once again. But basic resources to the top, real estate, construction materials also doing pretty well. Some of the laggards, auto parts and telecoms.
Yeah, and interesting to see, I suppose, how that China story is playing out as well, given that we're just hearing from Christine there and the interesting expectation of what more will come and what sectors that will target. Of course, property very much in focus, but perhaps other sectors looking to benefit as well.
Let's get to those individual stock moves then here in Europe. Joe Easton joins us with a look at some of the stocks that are moving this morning. And I was going to say climbing, and that is accurate, isn't it, Joe? Because they all are behind you.
Absolutely. So we're seeing we are seeing some moves higher. I've checked them on the screen. Daimler was seeing some early gains in early trading, up 3 or 4%. I think we're going to try and bring a couple of those up as well. But my memory is not what it used to be, so I'm glad we've brought those up. Daimler Truck, that's come down a bit, 0.5 percentage point, but still gaining slightly. Now, Dassault Aviation, they're benefiting from a deal with India. They're potentially selling some arms to India. That's the French company. They're getting a boost over there. Saab, SAAB over in Sweden. That's an interesting one. They're benefiting from the news that Turkey's potentially going to back that NATO story that we had in the news earlier in terms of the fallout from the Ukraine war. Sensirion, that one is called sharply lower, but it hasn't opened yet over in Switzerland. That was called as much as 10% low. I did see some early indicative pricing on the terminal just now, but not quite opened yet. I noticed we had Kingspan over in Ireland jumping about 13%. I think we're also going to look at some of those analyst broker moves that we had earlier. So Bankinter over in Spain, that one was rising after a upgrade at UBS, which sees some income boost. Deutsche Bank slipping very slightly in early trading. There we go, down 0.7%. That's been downgraded at SocGen, which is more negative than a lot of the US exposed companies. Michelin downgraded over at Jefferies. They're down 1.2%. They're worried about the valuation. And Dowlais, this is the company spun off of Melrose. They've got an oversupply issue in electric vehicles. According to Citi, they've been cut to sell and are down 4%. Citi recommending buying Melrose, selling Dowlais, that one getting hit. Those are the broker moves moving the markets this morning.
Joe, thank you very much. Joe Easton from our equities team dealing with some technological challenges there. We thank him for that. Here's what we're watching out for later today. 10 a.m. we get the German ZEW survey. So that's for the month of July. Survey expectations on the German economy. Then at 3 p.m. the US Senate is holding a hearing on the PGA golf deal with Live Golf of Saudi Arabia. Later today, St. Louis Fed President James Bullard will be speaking at the National Association of Business Economics. And finally, NATO's annual summit in Vilnius in Lithuania gets underway, running through to tomorrow. And that's where a lot of our focus has been, Stephen, geopolitically, that NATO summit in Vilnius. Our colleague Maria Tadeo on the ground there, she's been speaking. She was speaking yesterday to the Lithuanian president, and we heard from him this morning. We also heard from Jens Stoltenberg, the Secretary General of NATO, saying we are all safer, NATO members he means there, we're all safer with Sweden's membership. And it seems the path for Sweden to join has been cleared here. So that's one of the sort of events on the calendar to focus in on.
Indeed, yeah, and of course plenty more to discuss as well in terms of Ukraine, but also the disagreement among NATO members about cluster munitions and what exactly that's going to mean for the support they provide to Ukraine after the US agreed to do so as well. Interesting to see there's already share price reaction actually to that move on NATO from SAB as well.
Yeah, absolutely. So in terms of the data, we have to wait really till tomorrow to get the sort of next big data point globally. That's the US CPI print, but we've already had a lot of UK data, sent the pound a little higher on the back of that wage story. We need to talk about what's going on in the US.
Yes, we do. Coming up next, a New York Federal Reserve survey shows US consumers' short-term inflation expectations have fallen for a third consecutive month. We'll discuss the US economy next. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg.
Today, Bloomberg is live in Lithuania for the NATO Leaders Summit. Support for Ukraine, expanding partnerships, broad security challenges. We're bringing you news from the meetings and what they mean for the markets.
At the summit, we'll actually make important decisions to address our two main threats, Russia's aggressive actions and our efforts to fight terrorism.
Continuing coverage today. Bloomberg, your global business authority.
My view is that the funds rate will need to move up somewhat further from its current level and then hold there for a while as we accumulate more information on how the economy is evolving.
As we get closer and closer to what we think is a sufficiently restrictive level, that's part of positioning ourselves so that we can try and get to that target level in a careful way.
One of the surprising things about the economy is just how much momentum it continues to have. We're likely to need a couple more rate hikes over the course of this year to really bring inflation back into a path that's along a sustainable 2% path.
Fed officials there signaling that more rate hikes may be needed to bring inflation back to the central bank's target. Let us just check where we are on markets then. That's one of the news items we're dealing with, if you like, some further hawkishness coming through from central bankers and from Fed officials overnight. But that hasn't dented sentiment for risk assets because actually we've seen news flow from China sort of offsetting that. Expectations of further stimulus in China ongoing as we see support coming through via the banking sector for property names. Let's talk about where we are on markets then. Joining us is Haig Bathgate, Head of Investments at Atomos. Very nice to have you with us, Haig. Thank you for joining us. We were hearing there from various Fed officials about the need for further hikes in interest rates. I mean, we've heard that before, we saw it in the dots, and now we keep hearing them say it, of course. So our expectations firmly set there. You say in your notes ahead of our conversation, you think inflation will fall sooner than people think. Our guest last hour was saying he thinks inflation will stay elevated for longer than people think. Yes. I mean, it takes a number of views. So why your focus on the downside for inflation?
Yeah, I think it's, when we came into this initially after the pandemic and the lockdowns, nobody thought inflation would be where it is today. And we saw this particularly with Andrew Bailey, very, very slow to react. And I think a lot of the central bankers, because of the immediacy of information, they're very reactive, they're very myopic. And obviously remember that inflation is the year-on-year change in prices, so it can fall very, very quickly. We're talking a lot about wage inflation and the like at the moment. And that's always a lagged effect. Obviously, it doesn't feature directly in the inflation measure itself. But we have seen wage inflation, and again today in the UK, we've seen wage inflation consistently fall behind inflation. And I just think, again, when you look at the year-on-year effects, grain prices down over 70% now. There's a lot of things that can contribute at the same time to bring inflation down very, very quickly.
That wage data, as you say, lagging inflation, but still very high.
Yes.
And that's the thing, is that growth in earnings is still going to be a concern. We know that's something the Bank of England's keeping a very close eye on. Yes. Is that still low enough to I suppose, support a decline in inflation?
Yeah, I think so. I mean, I think there's obviously this game of double bluff at the moment in the Bank of England. They're trying to encourage employers not to increase wages because that's when it can become self-propagating, as we saw in the 70s as well. But also remember, the more wages go up, the more incentive there is to replace people with technology. Again, we saw this in the 70s. The 70s was one of the biggest periods of innovation. We've got AI just coming over the hill. We saw Microsoft again announcing 10,000 job cuts earlier this year. They've now topped that up again. I think we're only just at the start of this sort of substitution effect. And I think the position in the UK is quite unique, and obviously there is some sort of latency after Brexit. But I do think, particularly in the service sector, there are lots of opportunities to get efficiencies, and ultimately there is a tipping point beyond which you'll just say we're not going to recruit more people, we're going to actually invest in technology.
Right, and all of that happening at a time when new technology is available, such as AI. Let me ask you about UK assets. I know that you run a global mixed allocation fund, but thinking about your expectations for UK corporates, very topical given the Mansion House address yesterday. You're quite negative on UK quoted companies. Why is that?
Yeah, just generally quite negative in the UK economy in particular. The UK is much more sensitive to movements in the short-term interest rates. Obviously, the US mortgage market is very much based in 30-year fixed-rate mortgages. And also we've seen, again, today, two-year mortgages go up to 6.63% on average. And that's really sort of cataclysmic. If you've remortgaged 2 years ago in the depth of lockdown at 1 or 2%, and you're going to 6%, I mean, that's just going to choke off consumption at some point. We're starting to see some spillover into the real economy as well, and I think this is why it's so precarious and quite a dangerous game for the
big question is just how quickly we get to that point.
Yes, yeah. And these things usually happen. There'll be some sort of tail event that will happen. We've seen Thames Water, we've seen some of the utility companies already coming under pressure. And this is the problem when you focus so much on something like wage growth, you might miss something else which sort of comes over the hill and then causes some sort of issue.
Where else are you looking for cracks then?
So I think Western markets are quite different to emerging markets in China. As we saw, the Chinese didn't provide nearly as much stimulus, so they don't have the after impact of the inflationary pressures. But it's the long duration assets. We've seen it with the utility companies. There's a ticking time bomb in real estate. If rates remain where they are, there's a funding wall coming through. And of course, the most leverage is applied to what people deem to be the lower risk assets, particularly long duration assets like property. But I think we could see some cracks emerge in areas like utilities, real estate particularly, and you were commenting about that earlier, is the worst combination, because that's illiquid assets with lots of debt that needs to be refinanced.
And how does that manifest itself then, Haig? How do we get to a point of some sort of point of crisis then in real estate? Will it be commercial real estate? Is it residential?
Well, I think, again, it's sort of history chimes, but there'll be some event that happens that we don't see. You can't have rates going from close to zero to where we are at the moment without some cracks emerging. There's always people who take on excess leverage. There's always something that happens, and it's always some sort of squeeze in liquidity. So again, the risk of this turning from the sort of financial markets into the real economy becomes higher and higher when rates go to the levels that they are at the moment.
What's your view on sterling now? Because we're looking, of course, that jump that we've seen in the pound this morning after the wage data as well. I mean, is that going to be a problem?
Yeah, well, actually, that's quite good for inflation, obviously, because the stronger sterling is, the less it's going to cost us to import things. Sterling's always been a risk-on currency, so when sentiment's quite good, plus you've got the carry with sterling at the moment, I don't see that being particularly sustained in my own view. I don't think what's happening in the UK is particularly constructive for the long-term growth of the UK economy. I think there's policy errors on the side of the Bank of England, which we'll look back on in 6 months' time when you see that half-point increase. Yeah, I wouldn't be particularly long sterling personally at the moment.
Okay, Haig, thank you very much. Haig Bathgate there, Head of Investments at Atomos. Coming up next on the programme, major US banks could be facing one of the biggest regulatory overhauls since the financial crisis. We'll bring you the details. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
News breaks. No one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
IS's markets today. We are 23 minutes, let's call it, into our European trading day, and the mood on markets is quite positive. We're up around 0.4% on the Stoxx 600. The FTSE 100 is fairly flat. The CAC 40 and the Xetra DAX both making gains this morning. Essentially strong news flow coming through, or strong trading coming through from the Asia session, driven by that news flow around China. Some news around support extended to the property sector, but also an expectation of further support to come. That is pushing us a little higher for European stocks. Basic resources, construction and materials are the best performing sectors, including Kingspan doing very well, the Irish construction business. Just want to make reference to the fact that we are expecting President Biden to arrive at the NATO summit. It's taking place in Vilnius in Lithuania. We're expecting him to arrive shortly. We'll continue to monitor these pictures for his arrival. We've heard from the Secretary General of NATO a little bit earlier on, suggesting that the admittance of Sweden will make the alliance stronger. That has been the big development over the last 24 hours around Sweden as focus turns to conversations around Ukraine. So let's leave the geopolitics there for a moment. Major US banks are facing what may be one of the biggest regulatory overhauls since the financial crisis. The Fed's Michael Barr announced changes likely to substantially increase capital requirements for US lenders.
Requirements overall, but I want to emphasize that they would principally raise capital requirements for the largest, most complex banks. We intend to consider comments carefully, and any changes would be implemented with appropriate phase-ins.
Let's bring in for analysis Bloomberg's Tom Metcalf, who follows, of course, the banking sector. Tom, very good to speak to you this morning. So what are the likely changes, and what could they mean for the sector?
Yeah, basically higher capital requirements for really the biggest US banks. To give you a sense of that, it was suggested it was about $2 for every $100 capital they hold. So a change. What the analysts are saying, that is, within the capabilities of the banks, but obviously for the banks themselves, that is something that would be a drag on profit.
Where would these changes put US banks in relation to their European counterparts?
Well, this is the interesting thing. Coming into this, you'd think maybe the US banks are less regulated than the EU, but actually the ECB came out and said, our European banks have a lower sort of regulatory burden than in the US. So this would stretch that. Again, it's sort of more of a sort of minor shift, but it does go to show just how closely regulated the banks can be in some areas in the US.
Why the big banks then? Because I thought all the issues were around smaller banks. I should just mention, talking about the US economy, we are watching those pictures from Vilnius of President Biden arriving at that NATO meeting. So we'll keep those pictures in view, but talk about the banking sector. I mean, why put these increasing requirements on the big banks when I thought it was the small banks that got themselves in such trouble?
Absolutely. The Silicon Valley Bank crisis, obviously, that's really put the focus on those smaller ones. I think the point is it's this idea of just how systemic those big ones are. So, that regional bank crisis, obviously very turbulent, but didn't really impact sort of the wider financial system. And so they're really most worried about, say, those huge banks, because if there were troubles there, I mean, that would be a very different matter.
Okay, Tom Metcalf, thank you very much for joining us, the details of that story. Coming up next, UK wages grow faster than expected, putting pressure on the Bank of England to keep hiking rates. Plenty more on the UK economy next. This is Bloomberg.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called Red Wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. A trio of Fed officials say more rate increases are needed to quell inflation. But global equities rally on speculation China is preparing to boost economic stimulus. Turkey agrees to back Sweden's NATO membership, a breakthrough for the alliance, strengthening its defences amid Russia's war in Ukraine. Plus, sterling jumps to a 15-month high on stronger than expected UK wage growth, putting pressure on the Bank of England to keep hiking rates. And Stephen, the focus here in the UK then very much on the Bank of England story, how it responds to that wage data. From a broader markets perspective, it's the China story driving up risk sentiment.
Yeah, which is interesting, although we are seeing the FTSE 100 actually underperforming on the markets at this point of the trading session as well. So although sometimes we see China boosting those basic resources shares, which helps the FTSE 100, not the case in trading today. So let's take a look and see at how markets are moving at this point, half an hour into the trading session. So the Stock 600 up by 0.4%, the DAX in Frankfurt up by 0.3. As we say, the FTSE 100 actually slightly dipping into the red at this point in the session. We had a little bit of strength earlier on, but the FTSE 100 definitely the laggard on European markets today. So that big China expected stimulus story, along with that story about extending property loans, playing out across markets today. But the sentiment overall positive in the European trading session at this point in the trading day. Let's take a look at how the sectors are moving and which sectors are on the move this morning. So as I say, basic resources definitely one to watch for the read across from China, up 1.4% actually in trading today. Construction and manufacturing doing very well as well. That's mainly being driven by Kingspan, the Irish construction company today, which is one of the ones that is moving a little bit higher. Autos, though, underperforming, down 0.4%. Interesting, the news that we had out of Renault overnight to do with a new partnership with the Chinese car maker Geely. So that's one of the interesting shares to be watching there as well. Banks flat after we had, of course, the Mansion House speech yesterday, but there's construction and manufacturing sector up by 0.9% this morning as well. Industrial shares up by 0.5% too. So that China story again playing through what we are seeing here in terms of markets as well.
Okay, so that's the picture across markets. As you say, Stephen, yeah, that FTSE 100 underperformance, quite notable today once again. And let us get to some of the talking points around the UK story this morning. Data out this morning showed that the UK wage picture grew faster than expected in the 3 months to May, while the unemployment rate rose to 4%. In a speech at London's Mansion House yesterday evening, the Bank of England Governor Andrew Bailey said wage growth is currently too strong to rein in the country's rampant inflation. And we've seen proof of what he's talking about today, I suppose, in those numbers coming through on private sector wages. All of that conversation coming against a backdrop of Chancellor Jeremy Hunt unveiling plans to try to boost growth and adding reforms to the pension industry, the investment space in the UK. Joining us, Michael Eakins, the CIO of the British insurers and pensions company Phoenix Group. We're also joined by Rachel Kent, partner at Hogan Lovells and advisor to the UK government on financial, who's done a specific review on investment research and the environment for investment research. Let's get to these two conversations now, as informed by those Mansion House speeches. Michael Eakins, CIO of Phoenix Group, then thank you for joining us. Let's come to you first. So you've made the commitment, Phoenix has made this commitment, along with a number of other insurers and pension providers in the UK, to invest more money in sort of early stage businesses. This is all quite voluntary, though. I wonder how meaningful a commitment this is from the sector.
Well, look, last night's Mansion House speech is really, really important, Anna, because it sets out a voluntary intention of expression to invest 5% of defined contribution assets in unlisted equities, including venture capital and early stage growth companies. And the demand is absolutely there from the fledgling companies, but it's also incredibly important for our savers because it delivers them real long-term diversified returns over the many decades that they are saving in terms of wealth accumulation to get to that retirement.
What will it mean in terms of the change in that position? I mean, if it's such a good idea, surely you're doing it already.
Look, it's really important that industry collaborates on this, and that's one of the key outcomes of the compact last night is the signatories. The fact that a number of the leading investment firms are saying that they're willing to invest 5% of defined contribution assets by 2030 in unlisted equities. Now, if we do this by 2030, that will unlock £50 billion that can be invested in productive assets that have got a tangible second and third order impulse on the economy and deliver those long-term returns for our customers.
But to Stephen's point, I mean, why hasn't this been happening already? What is it about? Has it been that the regulation has blocked this from happening? What's new?
What we need is three things. We need government support to see this through. We need the appropriate regulatory framework, and that regulatory framework has to have consumer protection at its core. But what the compact also does, it stimulates a debate around risk and return in the UK. For too long, people's savings have been invested in very cheapest chips asset strategies. And what this is saying is actually what we should be really looking at is the value proposition for the end consumer and the saver.
What pensions have often been going into, though, is government gilts and fixed income products. And I mean, the government doesn't want to see all the money rushing out of that and into other areas, does it? So I know that this is a change sort of, to a limited degree. Is there any danger for the government in signalling it wants money to go into one part of the economy versus another? I mean, gilt's a little challenged at this time.
No, look, pension schemes, whether defined benefit or defined contribution, will always have a meaningful allocation to fixed income, including gilts and sovereign debt. What we're saying here is a really modest exposure to unlisted equities and to productive assets. And to put that in context, the UK is the second largest wealth nation in terms of pension assets, with £2.4 trillion. Today, the UK invests 9% in productive assets. Now, if we contrast that to our peers, the top 7 developed nations in the world, their average allocation to productive assets is 23%. So we are 14% behind our international peers.
But is that because there aren't UK companies to invest in?
No, absolutely, Stephen. There's a material number of UK companies to invest in. We invest a lot. Phoenix, as the UK's largest long-term savings and retirement provider, we invest a lot in universities. We see a lot of fantastic companies and real intellectual property come out of universities. And these companies are highly sustainable in nature. They're going to really accelerate the path to carbon net zero. And we shouldn't lose sight of the fact that the UK needs to invest £2.7 trillion over the next 15 years just to stay the course on the path to carbon net zero. And the insurers, UK insurers, stand ready to invest 0.9 trillion of that, a third of that. And the compact is really important in delivering that.
So what is the link between this push for money to go into startups and net zero? You're linking the two?
Absolutely, we're linking the two. Many of these startups that we already invest in today in very modest size, but will do more on a going forward basis, are highly sustainable. They're disruptive. They're the companies that are producing the new technologies that will accelerate the path to carbon net zero. And it's really, really important, not just for our savers, but for the prospects of the long-term wealth of the UK economy as well.
Okay, let's get to the other part of our conversation. Rachel Kent from Hogan Lovells waiting patiently with us there. And Rachel, of course, the part of the news from Mansion House that we want to speak to you about is the unbundling of research and trading services that's now going to be allowed in the UK as a sort of rollback of the EU MiFID regulations. You wrote this review. How substantial a difference is this going to make? How much more attractive does it make listing in the UK if these rules are changed?
I think investment research, we spoke to a lot of people in our market. There's very strong support both for the skills and capabilities we have, but also for the vital role that investment research plays in the ecosystem. So it is felt that investment research obviously provides information, it shines a light, and it can shine a light particularly on those new and innovative companies that Mike was just talking about. Shining a light on it that way leads to better valuations, it attracts investors, that leads to better liquidity, and all of those things together contribute to the attractiveness of the UK as a listing venue and a place to do business. So huge support for the concept of investment research. But there are some problems, and I should say the first problem, the Mansion House, the Chancellor last night at the Mansion House, and indeed Mike and his colleagues went some way to solving last night, and that is demand in those sectors. So you can have all the excellent research you like. If you don't have demand, you won't achieve anything. So that is an absolutely key component in this jigsaw. There's another issue, though, in relation to investment research, and that's the one that we were trying to resolve, and that is funding. So you've mentioned the unbundling rules. In short, the MiFID II unbundling rules have had an unintended consequence of leaving the funding for investment research largely on the P&L of the buy side. So the first thing we wanted to do, as you've indicated, is change the rules to give managers much more flexibility about how they charge and how they agree with their customers they're going to charge. So that can now include, or hopefully will include, the ability to charge on a bundled basis in a more efficient way.
Okay.
Rachel, is there a risk that the quality of that research goes down? Is there a risk that you lose in quality by bundling those fees and requiring them to be packaged together? Or rather,
no, I don't think. I think we obviously want to maintain some of the better parts of MiFID II to ensure that there's a continuation of the monitoring of, if you like, of what research is being paid for and received. So that part of MiFID II, I think everybody would support, but absolutely not, quite the opposite. The problem we have at the moment, as I said, is lack of funding. So if you get more funding into the system, you can have more analysts focusing on less companies per analyst, and I think that will have an increasing effect. But just because you change regulation does not mean you solve the problem. It requires a change of culture and the buy side and their clients to take a different approach to who pays for this. If you like, a more equitable allocation of the costs of research. And that is why, in addition to unbundling, in case the bundling provisions don't solve the problem, we have recommended the creation of a platform to bring together issuers who are badly in need. These new innovative companies that Mike mentioned are badly in need of coverage of investment research. We bring those together with people who can provide that research and inject funding into that system. So we're not going to wait to see if those unbundling rules work. We are looking at that platform to trigger that change much more quickly than might otherwise be the case.
Rachel, does this give firms in the UK a competitive advantage over those countries in the EU who are going to continue to be operating under the MiFID II rules? And is it going to help to solve the problem of a lack of London listings?
Absolutely so. I think two things happened during the course of our review. One was the European Union actually issued proposals to change their own provisions to look at bundled charging. So it's quite the opposite, if you like. If the UK don't make these changes, then it is the UK that will be the outlier, as between the US and the EU. And if we don't have these provisions, it's going to make it very difficult for people in the UK to access investment research in the US in a compliant way.
Mike, coming back to you just finally, I mean, Jeremy Hunt, the Chancellor, has cast these changes not as Big Bang 2.0, trying to set some different level of expectation, perhaps. So how significant would you say this is, in summary, for London?
Look, we do believe that this is materially significant, and it's a step in the right direction, getting people's long-term savings. And we shouldn't lose sight of the fact that when we invest people's pension wealth, that £2.4 trillion, we're investing with a time horizon, not of a single-digit number of years, but a single-digit number of decades. And it's absolutely appropriate that we have a very modest allocation to unlisted equities, venture capital, early-stage growth that can really help deliver those returns to people so that they can have a life of possibilities when they retire, but can also be the stimulants for the UK economy as well.
Okay, Michael Eakin, CIO of the Phoenix Group, thank you very much for joining us in studio, and also to Rachel Kent, partner there at Hogan Lovells. Coming up, Turkey has finally agreed to support Sweden's NATO bid. President Biden says he's not at all surprised. We'll be live in Vilnius to get the latest next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
This is Markets Today, 14 minutes away from being an hour through the trading session. So that makes us 46 minutes into the trading session. We've got European equity markets making modest gains. The London market left behind a little this morning. We are focused on NATO. We're focused on Vilnius over in Lithuania, where we're getting the latest news lines coming to us from President Biden, who's just arrived there. He says that he's not at all surprised that Turkey has agreed on Sweden, that by which he means the admission of Sweden to NATO. He is talking to reporters there. You see him seated with the Lithuanian leadership, which is, of course, the leadership that is hosting this event. Our colleague, Bloomberg's Europe correspondent, Maria Tadeo, is on the ground for us in Vilnius and can bring us the latest lines here. So, Maria, Turkey agreeing to back Sweden. What do we think brought about this change? I'm interested to see that conversations about F-16 jets take place later today.
Yeah, and that conversation around the fighter jets will happen today
when President Erdogan and President Biden speak in a bilateral meeting that is expected to take place today. Now, the U.S. president said he's not surprised about Sweden finally getting the green light, because we know that he had been involved in some of the back-channel talks to get this ratification going yesterday night. Nonetheless, this is a huge breakthrough for Sweden. Now, this green light from President Erdogan almost instructing this vote in the Turkish parliament to ratify the country into NATO as, quote, soon as possible. And Anna, you see that this already had a trickle-down effect, because today the Hungarian foreign minister, remember, it wasn't just Turkey. Turkey was seen as the most complicated hurdle to clear for Sweden, but it was also about Hungary. They have not ratified that bid yet, and today the foreign minister is suggesting, of course we support Sweden. This is just a technicality, and we will go ahead with this vote. For Sweden, this is the news that they wanted to get. You should have seen the smile, obviously, on the Swedish Prime Minister yesterday night when that deal came through, and now it really is just about the formalities, the technicalities, but it is very fair to say Sweden will become the 32nd member of NATO.
Okay, an expanding alliance. Maria, what can we expect from the NATO summit then in terms of Ukraine?
Yes, that's the other big topic on the agenda, and I would say from now on, all eyes turn to Ukraine. The President of the United States has already arrived here. Remember, he had said in an interview that he did not believe the country was yet ready for a formal invitation to join NATO, again alluding to the fact that this is a country that is at war. But today, the NATO Secretary General, Mr. Stoltenberg, said even if they don't get that formal invitation, which, by the way, the Ukrainians were not expecting, they're aware they're fighting a war, they can still get a good package, comprehensive package on the funding, the weapons, but also a political signal. And we know that political signal that Ukraine wants to see in that communique is a very specific one that says Ukraine will join NATO when the conditions allow for the country to join. Will they get that? Obviously, we're going to see a lot of diplomacy over the next 48 hours here in Vilnius. A lot of it already started, but obviously what matters is the communique and what goes in it. So again, a lot of conversations will be happening behind the scenes and then waiting for that communique tomorrow.
Of course, and you'll be across all of those lines for us. Bloomberg's Maria Tadeo in Vilnius at the NATO summit. Thank you very much. Coming up next, we'll look ahead to the key US inflation data out tomorrow. That's next. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Bloomberg covers the world with unmatched reach, and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back. This is Markets Today. We are 52 minutes into our European trading session, and European equity markets are catching a bid today. It's a lot to do with China. The FTSE 100 trying its best to get into the green, and it just makes it. The Stock 600 as a whole up by 0.3%. We need to talk about what's happening in these markets, though, Stephen.
Yeah, let's bring in Eddie van der Walt from our MLive team. Eddie, great to have you with us. So the China story playing out, it seems, everywhere except London.
Yeah, look, China's stimulus will obviously be very positive for Europe. Europe is very connected to, to the broader China story. There's a lot of luxury goods makers here. If they export to China, and Chinese consumers are spending money, that will obviously be very positive for the European indices. The beginning of the year, they significantly outperformed. At the moment, they're struggling a little bit because, we are just not seeing that broad-based stimulus yet. But there's a lot of hope at the moment that China will have to do so, and some signals from Beijing as well.
Right, some signals, some hope, and some of that going into gold is your assessment, Eddie.
Yeah, we saw a little bit of a pop in the gold price this morning. It was quite significant because usually gold tracks the dollar and it tracks real rates. But this time gold just went on its own way and broke higher. And to me, that says that there's some bets that Chinese consumers will pile back into the market and start buying gold. China is at the moment the biggest consumer of gold, bigger than India.
Yeah, very interesting one to watch as well, and we're looking at that too. We're also looking ahead to the US CPI number tomorrow, of course, big data.
Of course. I mean, look, the question is whether the deflationary pressures or disinflationary pressures, I should say, in China starts to feed through into the US and to other developed markets. Now, I think there's little chance of that happening. At the moment, the core readings in the US is still very high. Wage growth is really high. So in the US, the pressure is very much still on too high inflation. I think that's probably what we're going to see again tomorrow.
And a quick word on what's been going on in Japan, because this perhaps under-mentioned elsewhere in the programme, Eddie. So just remind us of what we're seeing, because as we go through this year, a lot of focus on when and if the Bank of Japan decides to change tack.
Yeah, absolutely. And we had a very strong demand at a bond auction in Japan this morning, just with traders targeting the 5-year point on the yield curve, with the assumption that perhaps the Bank of Japan at its next meeting will move its yield curve control away from the longer duration bonds, maybe closer to the 5-year. So that's I think central banks really in focus at the moment, and that just brings that home again.
Okay, Eddie, thank you very much. Eddie van der Welt from the Markets Live team. Remember, you can get up-to-date analysis and insight from Eddie and the rest of the Markets Live team. It's not just Eddie, it's not just Mark. There are plenty of them. They're all right on the Bloomberg terminal. MLive Go is the function to use on your terminal. I mean, jealousy and envy is not an attractive personal characteristic, is it?
Why are you looking at me when you say that?
Best avoided. I'm reflecting on myself, because I'm looking at the inflation print for the United States. We're expecting to get this tomorrow. It's expected to come down from 4% down to 3.1%. In the environment we're in globally, that looks almost normal. It's not within target, but it looks almost normal.
Or even think back to the reading that we got out of Spain as well earlier this month too. I mean, that's a picture much closer to the UK, where you're seeing much diminished inflation. Of course, the picture in Germany slightly different from that update figure we got earlier. Their final reading on the PMI or on CPI there, showing that uptick from the previous month, looking at a level still below what the UK is looking at, but part of the concerning inflation picture when we're thinking about the next few months.
Yes, I mean, so interesting that Bloomberg Economics has done some research on why the inflation picture in the UK looks a little stickier than it does in many parts of the Eurozone, not everywhere, but many of the larger economies in the Eurozone and also in the US. So that's worth digging out. Just time, I suppose, to recap what we've heard on the UK. The pound getting a boost as a result. In fact, some of that boost now worked through and missing in action, but did get a boost on the back of that higher wages number.
Yeah, true. And look, that's something that we're seeing also being reflected in bets with the Bank of England too, and where we're going to see the Bank of England going now too. So we're looking at that peak of 6.25 now, looking like it's going to come in around the March meeting next year as well. But holding, and that's the question that we're seeing shifts moving on to.
Okay, so the evolving watch that is the Bank of England expectations. That is it for markets today. You can get insight from us and the team on the front page of the Bloomberg UK website by typing TLIV Go on the Bloomberg terminal. The Pulse is up next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Fenway Sports Group has become a $10 billion global powerhouse. CFO Julie Swinehart tells Tom Keene how she's helping the company raise its game.
Winning's at the core of everything we do here, and the balance sheet is so important to the success of the team.
Watch Chief Future Officer Wednesday on Bloomberg.
DOJ or other authorities
could face bigger challenges.
was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. A trio of Fed officials say more rate increases are needed to quell inflation. Stocks and commodities rally on speculation that China is preparing to boost economic stimulus. A boost for NATO. Turkey agrees to back Sweden's membership as leaders of the alliance meet for a crucial summit. We're live in Lithuania, plus the pound jumps as UK wages rise more than expected, maintaining pressure on the Bank of England to keep hiking rates. You can see a sterling 128.73. So if you look at the European markets map, a lot of the focus will be on the UK. Yesterday, we had this pretty incredible story. For the moment, it's pretty much flat, but we had this incredible story looking at valuations for the UK, the fact that they are probably the most attractive overall, simply because of the grim picture. Does that mean we'll see a bit of bargain hunting for certain investors wanting to come in and actually look at the FTSE 100? The picture across the board, look, it has everything to do with inflation. We're expecting a lot of Fed speakers later today. And the stock market yesterday really kicking off on a cautious note. Traders not only sifting through the marks of Fed officials, but really it's earnings season that starts in full on Friday when we have a lot of the U.S. banks. If you look at some of the concern resurfacing about the impact of many economic cross-currents on corporate profits, it's probably the big impetus that could make or break a lot of these markets. Now, we have three great charts for you. Everything stems from China. So we look at yuan longer term, but really this was once the economy that was the envy of all emerging markets. Now, a lot of questions on China and what it means going forward. There's also a lot of questions on whether this will be like Japan with no growth and whether we continue exporting deflation across the world. So longer term, renminbi 72068, and really encapsulates some of the angst out there on China, again, signaling today more economic support measures, saying that they're imminent because authorities are worried about, of course, the ailing property market, but longer term questions on exactly how much more President Xi can do. Then the other story we're watching very closely is the NASDAQ. This is an important one because if you look at how some of the big concentration of some of the big tech companies are playing out in the NASDAQ, even the NASDAQ is worried that they're just too long. If you look at the 6 biggest companies in the NASDAQ that were boosted by AI, they now make 50% of the weight, and so we will see changes on July 24th. Scarce on details on exactly what this means. But again, when we read the story, we thought we should spend a bit of time thinking about this overconcentration and what it means for your portfolio building. And then finally, we talk about treasury yields. I love looking at treasury yields being inverted. I know I get quite a lot of pushback on that from market participants, but it's a closely watched barometer of recession risk. And it's now around actually 27 basis points since March. Remember, it was inverted by 111 basis points. So that flattening yield curve changes everything for how we look at bonds. The other story today, and we're getting breaking news out of Temasek. This is a Singaporean wealth fund, one of the biggest in the world. It posted a minus 5% return for the full year of 2023. That's the worst showing since 2016. So we'll delve a little deeper into what this sovereign wealth fund got wrong. Now, later this hour, we'll also hear from the Temasek Chief Investment Officer, Rohit Sipal Milani. He's speaking to Bloomberg's Haslinda Amin exclusively. So China has signaled more economic support measures are imminent after authorities took a step towards supporting the ailing property market by extending loan relief for developers. Well, joining us now is Freya Beamish, Chief Economist and Head of Macro Research at TS Lombard. Freya, as always, great to speak to you, especially on China. I mean, this was the envy of most emerging markets. What went wrong in China?
Well, they followed the same playbook as Japan and Korea before them, and they got the same response. You funnel all of the resources in the economy towards kind of corporates and wasteful investment. You dig a big hole in the ground, you destroy the environment, and you end up with a destroyed environment and a big pile of debt. And kind of going forwards, the likelihood is that they'll face that same kind of balance sheet recession dynamic that Japan faced before them, and Korea to an extent faced before as well. I think in the Korean case, we had the consumer debt crisis in 2003, and you could say that would have been the end of household debt, which would be the offset to deleveraging in the corporate sector. But in the Korean case, they have managed to keep that going, and that's provided some kind of driver for them. In the Chinese case, it's hard to see that being a real driver because there's just no answer to how to deal with the problems that are being faced by the property market.
And that's exactly my question. I mean, I guess what's worse is that if you look at the options that President Xi's government have, they're not great. So how is he going to fix things?
Well, I was talking about this with a colleague recently, and the technical term we came up with was "it's a pickle," because the flow of funds has to balance, right? And if you're going to deleverage an economy without defaulting on debt, you have to run private sector surpluses. You have to reduce the deficit of the non-financial corporates, and that's exactly what they're trying to do. But to offset that, you either have to run a larger government deficit or you have to run a larger current account surplus. Now, the government deficit, if you look at on a broad spectrum, is already huge. And running a larger current account surplus is not going to go down well in the current global environment. So they can't just run that same kind of policy of trying to compress wage growth and trying to keep a larger current account surplus, trying to depreciate the RMB that Japan and Korea ran before them, because it just won't float, given the size of China and given the geopolitical backdrop and the kind of the political backdrop that developed markets are facing. So when you see this big ratcheting up of electric vehicle exports, that means that they are focusing on these green sectors, and they are trying to rebuild the current account surplus. But is Germany going to sit back and say, okay, well, yeah, fine, we'll just accept all of your electric vehicles to the detriment of our economy? I don't think so. So there's not really any clear answer to how to shore up Chinese growth.
So, Freya, what does this mean for the rest of the world? Again, we're starting to really feel the impact on commodities and equity markets across the world. Is there anything that the rest of the world can do to try and protect themselves, or at least, continue to buffer some of that impact?
So it's almost like you've got this kind of reservoir of disinflation in China, and all those economies that were beneficially exposed to the Chinese growth model in the 2010s, they have a big question to answer now with regards to what's their new growth model going to be. There may be answers to that on a case-by-case basis, but all of those economies, EM markets that are exposed to China, they have those big questions to answer. There are some positives with respect to growth and inflation for the rest of the world. If you think about the kind of the hollowing out of middle income being in some ways a direct response to the kind of the hyperglobalization period that we've been through in the 2010s and the 2000s. It's now possible with the kind of the loss of competitiveness of the Chinese currency and with the inability just to kind of ratchet up investment from here in China, that you start to see capex and capital deepening reawakening in developed markets, and that's starting to support productivity growth, and you also start to see kind of wage growth starting to be able to grow, to rebound in on a secular basis in developed markets, and that being able to push developed markets onto a more private consumption-led, income-led form of growth. So there are upsides to this, but how you kind of get exposure to that as an investor is very difficult, because it really flips the kind of the investing kind of model on its head. You can no longer just invest in the index. You have to get exposure to the real economy. You have to get exposure to capital goods on a secular basis.
And Freya, I mean, first of all, congratulations. Also, you have a great paper on looking at yields and some of the changes there. You know, the fact that also maybe the central bank liquidity impulse has bottomed. What does this mean for yields longer term?
Yeah, so I think in the short term, the story is very different from the longer term. So longer term, we're looking at higher growth, higher inflation. We're looking at greater uncertainty in the kind of the deglobalize or the kind of end of hyperglobalization. And all of that means kind of higher term premia. At the same time as you've got this shift away from the driving narrative being excess of savings to everyone all of a sudden competing for resources for capital, whether that's government or whether that's the private sector. And that all means higher yields on a secular basis. In the short term, though, we do think that kind of negative credit impulse is much more important for growth than the excess of kind of wealth that's still left over in the US and actually Japan by the pandemic. And that negative credit impulse, actually negative net equity impulse, if you can think of that as well, the kind of the change in the amount of wealth is much more important for GDP growth. And that's what's kind of pointing towards recession still. Yes, we do still think that there's going to be a US recession in the not too distant future. And therefore, in the short term, the tactical response is much different from how markets are currently seeing it and how things are going to play out on a secular basis.
Freya, thank you so much. As always, Freya Beamish stays with us. Now, Turkey has also agreed to support Sweden's bid to join NATO in a major breakthrough for the military alliance. President Joe Biden says he's not at all surprised by the agreement. And the NATO Secretary General, Jens Stoltenberg, welcomed the about-turn following months of drawn-out negotiations. Now, he's speaking now. The news came, of course, on the eve of a two-day NATO summit that starts this morning in Lithuania, bringing together 31 leaders from across the organization. Well, we have our Bloomberg Europe correspondent Maria today on the ground for us in Vilnius. So Maria, Turkey agreeing to back Sweden. What brought about this change? And good morning.
Good morning, Francine. And major breakthrough yesterday night. Obviously, the Turkish President Erdogan dropping that veto and now clearing the way for Sweden to join NATO. Now, there were a number of issues that were agreed yesterday bilaterally between the two countries. They talk about more cooperation between the two of them. They talk about a format in which they'll be able to monitor the commitments that were made in terms of security and counterterrorism measures that were agreed in their bilateral memorandum. But obviously, what matters here is that political signal from President Erdogan now instructing a vote in the Turkish parliament to ratify Sweden's entry to NATO. And Francine, we already see the trickle-down effect because the Hungarians, remember, it's not just Turkey, it was also the Hungarians. They now say this morning, of course, we support Sweden. This was just a technical matter and we will vote through. Now, at this point, Francine, we have seen that the United States and the President of the United States, Joe Biden, is here now in Vilnius, the session about to start, and really the focus turns to Ukraine. The country will probably not get this formal invitation to join, but it is looking for a political one that makes it clear they will join, quote, when the conditions allow. And Francine, at this point, I have to say, everyone here is on the lookout and just waiting for President Zelensky to arrive. We've been told he will participate, and that could happen any minute now.
Thank you so much, Maria Tadeo there. Of course, with the very latest, we'll keep an eye out for President Zelensky, and then we'll go back to Maria later this hour. So we'll have plenty more, of course, from Vilnius on this NATO summit.
and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The top names in business are on Bloomberg.
For Indigo, this is a 500 planes order. That's the biggest order ever in terms of number of planes. It doesn't change the short-term perspective on ramping up the production.
All our aircraft deliveries are delayed. The supply chain that was really decimated during COVID.
It's a real challenge for all the OEMs at the moment, but we absolutely have to have those aircraft delivered on time.
Nobody covers business like Bloomberg, your global business authority.
The interaction of above-target headline inflation with labour market tightness and demand pressure in the economy has made underlying developments in goods and services price inflation more sticky than was previously expected. And both price and wage increases at current rates are not consistent with the inflation target. Some of that tightening is still to come through the policy pipeline, and we expect underlying inflationary pressures to recede as headline inflation falls.
Well, that was the Bank of England Governor Andrew Bailey, who says the full impact of interest rate increases has yet to hit the economy and that inflation is likely to drop markedly this year. Now, still with us, Freya Beamish, Chief Economist at TS Lombard, and joining us, Marcus Ashworth, Bloomberg opinion columnist. So thank you both for either sticking around or coming on the program. Freya, when you look at what we heard from Mansion House, there's also, of course, an agreement between the government and some of the largest pensions about putting 5% into some of the startups to kickstart growth. What's your growth plan for the UK right now?
I think the focus, in some ways, understandably for them, has been both from Hunt and from Bailey has been on kind of trying to bring demand back down to supply. So you've got this kind of focus on inflation and demand, and then you've got this sort of focus on competition, which is their sort of buzzword for the supply side, and that's all about kind of trying to redirect finance to growth and startups. I think what's being missed is that there's a whole other part of supply that needs to be fixed and is currently creating this really intense bottleneck for the UK economy, which is partly why I think we're seeing these upside inflation surprises and why the outlook has been threatened to be more kind of stagflationary than elsewhere. And in particular, there's this misunderstanding of the competition between resources for the funding the government deficit versus funding the growth startups in the private sector, which, yes, everyone, as we said in the previous segment, that there is a big kind of increase in competition for funds, and that's why we think that the interest rate that secularly yields are going to be higher. But if the government spending is also reducing the number of people on waiting lists, if you're buying MRIs and that's increasing the productivity of doctors, if you're kind of increasing our kind of capex in the NHS and healthcare from what is one of the lowest in the OECD to sort of even to the middle, you're actually releasing a lot of those kind of bottlenecks that have caused the supply side deterioration on the labor market side, and that's just kind of missing from the whole debate. On top of the fact that I think that you will just kind of naturally over time start to see a re-deepening or kind of capital deepening, reawakening in developed markets as the kind of the hyper-globalization policy starts to recede into the 2010s. That's not what you're going to see in terms of the cyclical story with capex right now. Because the unit labor costs are just kind of too hot to invest for businesses to start investing. But I think that capital deepening starts to come through, and that starts to help productivity growth in the UK as well. It's not too hard to be above consensus in the UK.
Yeah, Marcus, I was going to ask, are you also above consensus? And actually, will productivity pick up?
I don't think we measure productivity very well in the UK economy, and it's very hard to sort of divine a way through it. I mean, as you may know, we tend to measure, as Freya was pointing out there, health and education, which is not a feature of European. It was supposed to be Eurostat's way forward, but we've adopted it and they haven't. So we look at our GDP in a different way now. So it's quite hard to compare and contrast. But I clearly see what Hunt's trying to do here. It's just, unfortunately, it's too little, too late. Some of it's tinkering around the edges. I'm not a big fan, or perhaps using private sector pensions to sort of do things into. It's not really private equity; it's more venture capital. And we've got a trouble here with the British Business Bank, which is flooding the sector. And I think a lot of startups are getting too easy money without enough rigorous controls going through, which is going to end up, a few years down the line being a bit of a mess, I suspect. But the government is tinkering at the moment. It's rearranging the deck chairs on the Titanic, and I hope it has some impact. But really, we have a sector, particularly in the labour market, which is very strong, and it's all that dominates, I think, for the Bank of England.
All right, thank you both. Thank you, Freya Beamish, Chief Economist at T.S. Lombard, and staying with us, Marcus Ashworth, Bloomberg opinion columnist. Now, coming up, Fed officials signal higher rates may be required to bring the central bank back in line with its 2% inflation target. We'll bring you the details next, and this is Bloomberg. So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Sellers are less eager to sell in an environment where they can't get the best price, and certainly rising interest rates have made it harder to justify higher prices, and so there are fewer deals available.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
My view is that the funds rate will need to move up somewhat further from its current level and then hold there for a while as we accumulate more information on how the economy is evolving.
As we get closer and closer to what we think is a sufficiently restrictive level, that's part of positioning ourselves so that we can try and get to that target level in a careful way.
One of the surprising things about the economy is just how much momentum it continues to have. We're likely to need a couple more rate hikes over the course of this year to really bring inflation back into a path that's along a sustainable 2% path.
Fed officials are signaling that more rate hikes may be needed to bring inflation back to the central bank's targets. Well, joining us now to dissect the latest comments from Fed officials and more is Bloomberg Opinion's Marcus Ashworth. Marcus, we talk all the time about dot plots, about what interest rates do, but actually it seems to me that everything has to do with inflation, and we're not quite sure how inflation behaves from now on. Should we worry more about a credit crunch and what banks' lending looks like?
I think we should, but I mean, I'm very impressed by how the Fed has managed to change the debate and move markets around almost at will. It got itself a little worried that the market was expecting, rate cuts this year, and in fact, there was a little bit of action yesterday pricing in some maybe in front end of next year, but they've talked out rate cuts completely, and now they're breathing in again. They expect another rate hike, the next meeting, and at least another one as well. I don't think they necessarily feel they have to go ahead with that, but they don't want the market pricing in, as markets tend to do. The second you stop hiking, it must mean at the end of the rate hiking cycle, and it must collapse. And they want this plateau, and they want to wait and see. But the great thing the U.S. economy is it's strong enough to handle it. Unfortunately for the U.K. and for the ECB, their economies are much weaker, but they are forced to watch and do what the Fed is. We are completely controlled by what the Fed wants to do with interest rates. And as they're not ready to turn yet, we saw a few central banks try stopping hiking, and they've all been forced back to hike again. So we are just totally dependent on what the Fed thinks.
Marcus, as always, thank you so much for joining us. Bloomberg Opinion's Marcus Ashworth joining us on the Fed and, of course, on the UK. Coming up, we'll be bringing you the latest from the NATO summit in Lithuania. Maria Tadeo is on the ground there. That's coming up shortly, and this is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Now, a trio of Fed officials say more rate increases are needed to quell inflation. Stocks and commodities rally on speculation that China is preparing to boost economic stimulus. A boost for NATO. Turkey agrees to back Sweden's membership as leaders of the alliance meet for a crucial summit. We're live in Lithuania. Plus, the pound jumps as UK wages rise more than expected, maintaining pressure on the Bank of England to keep hiking rates. Well, good morning, everyone. Welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Joe Biden says he's not at all surprised that Turkey has agreed to support Sweden's bid to join NATO. Leaders of the alliance are meeting at a summit in Lithuania where Ukraine's membership is also on the agenda. Well, Maria Tadeo spoke with the Lithuanian president about Ukraine's bid to join NATO, and he told her they expect progress soon.
We are ready to create institutional framework for closer cooperation with Ukraine. It will be done in form of Ukraine's NATO Council. And then that the procedure of entering or integration into NATO will be more simple without members' action plans. And probably we can agree on that too.
So no map for Ukraine?
No map, we can agree on that too. At least this is a position of my country, but I know that many countries too, and maybe all allies. And then we need to send a signal that Ukraine will become the member of NATO as the situation allows, meaning that if the war is over.
And that is exactly what they want. Is that sentence. Do you think you can get to that almost linguistic? It's about the grammar.
We are still in process of discussions, and I know that even now the discussions will start in 1 hour, and probably those discussions will be dedicated to this subject.
And what is the message to some of the allies? Because it's not just the United States. We know there's other allies who say this is a country at war, and there's a risk of escalation. And of course, we know that Russia will say, there you go, we're not fighting Ukraine, we fight NATO. What's your message to those allies? What will you say?
Yes, we all agree on that the country is in the war, and what will happen if let's imagine that we will just invite Ukraine to become the member of NATO right now. What will happen with Article 5? Should be activated, by the way. What means activation of Article 5? The Third World War. So this is the reason why we understand how serious is the situation, and what Ukraine needs right now is full support in military, economic, humanitarian means, and we are providing the military support to them. And I know that many countries arriving to Vilnius will bring additional portfolios of support to Ukraine. But we should also understand that Ukraine needs a signal about the potential membership tomorrow. And if we will be able to deal with that and to provide, to deliver this kind of support, political support to Ukraine, of course it would create huge stimulus, fighting spirit of Ukraine. I remember the story with candidate status towards European Union. And I had a conversation before we took those decisions, conversation with President of Ukraine, Volodymyr Zelensky. He said to me, look, maybe for these guys which are fighting on the battlefield, this is not a critical issue because they might be dead tomorrow.
Lithuania's president speaking to Bloomberg's Maria Tadeo in Vilnius there. Now, Maria joins us from the NATO summit. Maria, it was a great interview. We've had news on Turkey backing Sweden. So what can we actually expect on Ukraine from the talks?
Yes, Francine, and at this point, we are just waiting now for President Zelensky to arrive here in Vilnius. And in that interview with the Lithuanian president, Mr. Nausėda, this is a country that fully supports Ukraine. And in fact, if you take a walk around Vilnius, it is full of Ukrainian flags. Everywhere you go, it says, stand with Ukraine. And again, he repeated, in his view, Ukraine needs the strongest possible signal because if you keep them, quote, in the gray zone, that is the most dangerous place to be. He also said the country needs a morale boost. He also alluded to people that are fighting but may be dead tomorrow. The country has to see that they're fighting for something. But of course, we know that this formal invitation is probably not going to happen. The country is obviously at war, so that is a major issue to be taken into account. But they do want the equivalent of a political invitation that would signal once conditions allow, Ukraine will join. The NATO Secretary General also said even if they don't get the formal invitation, they can still get a good package. The funding, the weapons, all of this could happen in Vilnius. Will President Zelensky get it? I guess we'll find out in the next 48 hours, Francine.
Yeah, the next 48 hours, of course, crucial to understand the situation a lot better. Maria, thank you so much, as always, on the ground for us in Vilnius. Maria Tadeo, our Europe correspondent. Now, our coverage of the NATO Vilnius summit continues throughout the day. We'll also interview the UK Foreign Secretary, James Cleverly, a little bit later. We'll be speaking with the President of Finland. Stay with us for those very important conversations. Coming up, we take a look at the Magnificent Seven, accounting for most of the NASDAQ 100's recent surge. That's next, and this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Today, Bloomberg is live in Lithuania for the NATO Leaders Summit. Support for Ukraine, expanding partnerships, broad security challenges. We're bringing you news from the meetings and what they mean for the markets.
At the summit, we'll actually make important decisions to address our two main threats, Russia's aggressive actions and our efforts to fight terrorism.
Continuing coverage today. Bloomberg, your global business authority.
The conversations that matter, the insights you need. This is a pulse. I'm Francine Lacqua here in London. Now, this is the picture across the board. We look at the markets, but we take a little bit of a step back and try to really tell you the stories that matter. The picture for Juan is one of, for example, China really being the one that was the envy of all emerging markets just a couple of quarters ago. And now huge questions about what this economy will be going forward. Now, a couple of things we need to watch out for is, look, if you look at the stock market, kicking off the week on a cautious note, market momentum has slowed because the China economy is now caught in the grip of this grim narrative that perhaps few would have imagined possible before the pandemic struck. So the world's biggest factory, essentially, is what China has been, exporting deflation to the rest of the global economy. And so it has huge implications for what central banks could do. We're looking at it through the renminbi lens. We could look at it elsewhere at the moment, 72082, and this is a one-year chart for renminbi. The other thing we watch out for is really the closely watched barometer of recession risk, and it's ranged, if you look at the inverted yield curve. So it's, it has ranged from an inverted by as much as 111 basis points to as little as 27 basis points since March. Now, the flattening trend had gathered, of course, pace as expectation that the Fed's path forward towards pricing in a quarter-point interest rate hike this month and another increase by year-end. So we look at the 210s. We look also at the NASDAQ, again, set to adjust the weighting of its 100 components with the magnificent 7 stocks, and that's Microsoft, Apple, NVIDIA, Tesla, Google parent, Alphabet, Meta Platforms, and Amazon.com, currently accounting for more than half of the index's weight. So we'll talk, of course, about that. America's biggest tech companies have, in fact, become too large, even for the NASDAQ. Bloomberg's MLive's Eddie van der Walt is here with analysis. Bloomberg's Leonard Kensperper is also joining us. So thank you both for coming on. Eddie, I mean, I have so many questions. First of all, we tried to figure out if there's an over-indexation or if, one company is very big for an index. Is that really a problem?
Yeah, look, so this is what surprises me here. We don't really know the detail, but we do know that this is to address over-concentration in the NASDAQ. But the surprising thing is that the NASDAQ has really benefited from this. In another year, if the NASDAQ underperformed in a down market, I could understand this. But, the NASDAQ is up something like 38% this year versus the S&P, which is up only half of that, about 15%. So, it's significantly outperformed, and it is because of overexposure to NVIDIA and AI, to Microsoft with Bing suddenly doing well, now with Meta and its launch of Threads. It's because these small selection of companies are doing so well. But I guess the problem for an index like the NASDAQ is the over-concentration increases your volatility, right? And why don't you just buy those 7 stocks? Why do you buy an ETF that replicates the underlying if your vast majority of exposure is just to this handful of companies?
And Eddie, I love getting Eddie's live take on this because, again, we're very thin in terms of details, right? We don't exactly know how they'll do it. Yeah. But if these are companies that are priced to perfection, then I don't know whether, if there's a correction, how does the weight change?
Yeah, and look, and it's going to have an impact on the companies too, because, of course, a lot of people don't buy the stocks outright. Most people take exposure via ETF these days. So a lot of people, so if you reduce their concentration in the index, that means there's money flowing out of them, which then means that the company's share price will fall, and then at the next rebalancing they'll naturally be underweighted a little bit more. So I think the impact on the wider market is significant here.
We also look at the banks, and what was interesting, Leo, is that so we have Michael Barr basically trying to push through or looking at changing the way we measure risk. We standardize risk and some of the capital requirements for some of the big banks, but it's not necessarily going to go through.
That's true. So so first of all, this is all part of a broader review of US rules to align them better with Basel III rules, the international rules that will come into effect over the next years. And yeah, Michael Barr has said he wants Wall Street banks to use a more standardized approach, and also that they might tweak the Fed's annual stress tests to better account for risk. And of course, this is a big topic for investors as well, because higher capital requirements might result in lower payouts by those banks.
So Leo, are we expecting the banks to push back? I mean, what's the likelihood? This would be the biggest overhaul, right, since the financial crisis, if it goes through.
That's true. So there'll be an initial plan that's expected to be published this month, and the industry will weigh in. There has been criticism, but of course the Fed stance is, this increases lending capabilities in the economy, so it's a good thing, but there'll be no doubt pushback.
And then bonuses in London are going down. And this is basically because of the pipeline, right? The M&A pipeline. Goldman Sachs, firing a lot of people, but still paying out some of the best bonuses.
That's true. Interestingly, though, so this is a study, a survey conducted by Dartmouth Partners, a recruitment company, and they found that last year bonuses for London investment bankers dropped quite heavily, and of course this is because of the slump in deal volumes. And Goldman Sachs, interestingly, was the best paying investment bank in 2021, and now overall pay fell the hardest. So this really shows you, I think, that banks need to manage expectations of their employees when it comes to pay in this downturn to prevent them from leaving.
A lot of things. I mean, you're deputy leader of all this big markets team. We're going to the earnings season.
Yeah.
And that could be a real game changer for how equities perform.
Yeah, absolutely. Because look, stocks have pretty much ignored the hopes or the worries over a recession so far this year, right? Stocks have done significantly well, and that's on the expectation that there will be, that the Fed will be forced into rate cuts, but a lot of it's also built on the strength of the consumer. And the US consumer is still very strong. Even in Europe, the consumer has not really buckled yet, right? But if we continue to see rate hikes, if we continue to see the Fed and other central banks taking on inflation, then yes, I think we could see a significant pullback, in consumer spending, which will therefore feed back into stock prices.
Eddie, what's your chart of the day? I mean, so I love the inverted yield curve. Everybody disagrees with me, but it is flattening. So is it saying something finally?
Yeah, but you know what? I think it all depends on how we see that flattening happening, right? Is this a flattening that the Fed is forced into cutting again, and you see the front end of the curve falling relative to the back end? Or is it that we see inflation becoming more entrenched, more sticky, more longer term, and it kind of, that you see the back end of the curve rising because investors want more compensation, which actually would be quite bullish because it means that growth has stayed strong throughout this period. And I think that is what makes this time different, is how that reversion.
I like that. Reversion.
I just made that. Reversion is going to occur. How the curve is going to uninvert is probably a better way of saying it.
But Eddie, I mean, if you're the Fed, do you still need to make a choice between inflation and a credit crunch, inflation and basically bank lending?
Yeah, I think there is a little bit of that. I think that is the one thing that I don't think the Fed is that worried about a recession, actually, at this point in time. It is far more worried about stability in the banking sector. If we see instability, if we see renewed instability there, because the only time I've really heard Powell nervous in the last 6 months was when we had the US banking crisis back in March.
Yeah, and of course this feeds back into what banks are doing and some of the IPOs that may not be there because there's been a mismatch, for example, on how much people want to sell their companies for and how much buyers want to spend, and so that's going to be a really sticky point for a lot of the banks.
Yes, definitely. I mean, many banks hope. So I've spoken to many brokers in the city in recent weeks, and they're hoping for a pickup in the second half of this year. And some of the smaller ones definitely will need that to, get by.
Thank you both for joining us. Eddie van der Walt and Leonard Kenscherper joining us this morning on a wide range of issues from banks to a lot of what the markets are doing. Now, some of the other news, Bloomberg has learned that Wall Street banks are helping approach international investors, including sovereign wealth funds, for Syngenta's mega IPO in Shanghai. Citigroup, HSBC, JP Morgan, and UBS are working on what could be the world's biggest listing this year. The Chinese-owned seed giant won regulatory approval for the listing last month. Bloomberg has also learned that Uber CFO Nelson Chai is planning to leave the ride-hailing company. Now, our sources say Chai has informed senior leaders of his intention to move on, though a decision on timing has not been made. Well, Chai would be the most senior executive to leave Uber since they went public in 2019. Berkshire Hathaway has taken control of a liquefied natural gas export project in Maryland, while Warren Buffett's company agreed to buy Dominion Energy's stake for over $3 billion, boosting its ownership to 75%. The deal gives Berkshire control of one of just 7 international operational LNG export facilities in the U.S. We'll have plenty more on that throughout the day. Coming up, Aramco and ESG funds. We look into how the world's largest oil company became an unlikely beneficiary of money earmarked for sustainable investments. More on that next, and this is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, Saudi Aramco, the world's largest oil company, has become an unlikely beneficiary of funds earmarked for ESG investments. And that's because of a complex web of financial structures that the oil giant used to raise money from its pipelines. While seemingly unintentional, it's also raised questions about some of the methods of fundraising that are being increasingly used in the Gulf. Now, for more on all of this, we're joined by Tasneem Broger, our managing editor for ESG and EMEA. Tasneem, thank you for joining us as always. So how did this actually happen?
Yeah, good morning. So hold on to your hat because there are quite a few layers of financial engineering here. So Saudi Aramco is obviously blacklisted by a lot of ESG investors. It has very low, some of the lowest possible ESG scores. But what happened was that back during the pandemic, it created two pipelines, one for oil, one for gas. It then sold 49% in each of those to two groups of investors, one led by EIG, Global Energy Partners, and the other led by BlackRock. Those investor groups then got bank loans, bridge loans to pay for that investment. But then to pay back the banks, they created special purpose vehicles. And those special purpose vehicles were registered in Luxembourg. And they then got a very decent ESG score so that when they issued bonds, those bonds ended up being bought by ESG investors. Now, one has to remember, of course, that the sole purpose of those bonds was to finance those two oil and gas pipelines.
So, Tasneem, what does this actually say about the guardrails around ESG?
Well, I mean, this is an unusually complex set of structures that clearly retail investors would have a very hard time penetrating, but even professional investors often wouldn't know that they are in fact own bonds that somehow have this connection. So it just goes to show that that the layers of complexity really make a huge difference here. The other thing is that part of what enabled all of this is the rating on the SPVs. And so in Europe, the European Commission last month actually put forward a sweeping proposal that means that the entire ESG ratings and ESG scores industry is going to have to sort of come under much more uniform and transparent regulations in the not too distant future.
So, Tasneem, are there any regulations in the pipeline that will actually address any of these issues? And could that be on a global? Would that need to be on a global level?
So until now, what has happened in the EU in terms of ESG regulations has tended to have global ramifications, like the SFDR regulation for ESG investors. And so the expectation is that when the EU starts regulating ESG ratings and ESG scores, which will be the first time that that's happened in the history of this sort of mushroom or this cottage industry of ratings, that will have ramifications also on a global scale that will hopefully give ESG investors more insight into complex structures like this one.
Tasneem, thank you so much. Tasneem Broger there, our managing editor for ESG in EMEA. Now, our coverage also of the NATO Vilnius summit continues throughout the day. We'll interview the UK Foreign Secretary, James Cleverly, a little bit later on. We'll also be speaking with the President of Finland. In the meantime, a couple of things that should be on your radar. NATO did notch up a significant breakthrough yesterday, just hours before the start of the summit, and that's when Turkey agreed to stop blocking Sweden's bid to join the defense alliance. And then we also understand that President Biden will meet with the Turkish president later today, when the two will likely discuss Turkey's request to purchase some F-16s. The markets firmly focused on what we saw in the UK in terms of wage growth. This complicates certainly the matters for the Bank of England, and the UK two-year mortgage rate is hitting its actually highest since 2008. I don't know if we have a market board for you. If we have it, then this would be an ideal time to actually bring it up. If you look at the average rate for a fixed two-year home loans, it rose to 6.6%. That was today. Again, UK households facing an avalanche of cost pressures triggered by rising interest rates and the worst cost of living crisis in a generation. Up next, Bloomberg Surveillance Early Edition with Kriti Gupta in New York, Danny Berger in London, and this is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie? What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Digital Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
News breaks. No one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
From New York City, from London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Still hot labor market. UK wages rise more than expected in the latest reading, keeping pressure on for higher interest rates. The data equaled the highest level on record last month and in 2021. More work to do. Fed officials say higher rates are needed to bring down inflation to 2%. Barr, Daly, and Mester all call for additional hikes this year, while Bostic says be patient. And NATO summit is in full swing over in Lithuania. Sweden wins its final backing needed from Turkey to join the alliance. Welcome to Bloomberg Surveillance. It's the early edition. I'm Danny Berger in London. Kriti Gupta is in New York. Kriti, the future session really is struggling to hold in to those very slight gains put in yesterday.
It is. What's interesting, though, is it's coming off of an Asian session that was a lot of green on the screen, mostly coming from this idea of stimulus in the Chinese property market. But what's interesting, Danny, is it's not having a real read-through into the session, at least into the U.S. session, I imagine the European session as well. Futures, we're looking at kind of virtually unchanged right now, but tilting to the downside. You are seeing sentiment sour even in just the last 30 minutes or so. Futures at about 44.41 when you look at those contracts for our radio audience. The bond market gets interesting, though, because that two-year yield really pulling back. A lot of this was yesterday, but still worth checking in on. 483, pulling really far back from that round number of 5%, down about 2 basis points. As that front end of the curve retreats, though, you do start to see the dollar take its cue, down about 0.2%. Now, ordinarily, the dollar movement lately has been a function of what's happening in the euro and the cable rate, even arguably the Mexican peso and a lot of the commodity exposed currencies. Not today. We're going right back to the bond market story, which makes the commodity story even more interesting, because if you're starting to see a bond market price in more recessionary risks, perhaps, of pricing in a Federal Reserve that may need to reevaluate cutting rates despite some of the rhetoric that you are hearing from those government officials, the commodity index tell you something very different. Gold, copper, oil, all higher on the day, Danny. The index higher by 0.4%.
Kriti, I want to bring us some breaking lines over the Germany ZEW survey coming in for July. It's an interesting one. So current expectations or current conditions actually did better than expected, still much lower, but not as bad as we thought it would be. However, expectations going forward in the ZEW survey is worse than expected. That came in at a negative 14.7. The estimate was for a negative 10.7. So that's not great news, and we didn't expect it to be good news considering that Germany did fall into a recession in the winter. We had that official data come through. Now, when it comes to this equity trade, it is very spotty throughout Europe. You have the UK doing really poorly, down 0.4%. CAC that's up 0.4%. Kriti, you mentioned China. This is where we're seeing it come through. It makes sense that you would see some more spots of it come through in the European session. For example, LVMH, all those luxury goods live in France. Those are getting a boost, hence the CAC is doing better than the overall index. Now, the other area we're seeing that China story play through, if we can switch it up, is on basic resource stocks. We are seeing basic resources in general, the actual commodities, do better today. So the companies that are tied to it, the miners, even construction companies, those are outperforming today. So basic resources, the best performing sector in the European trade, that's up nearly 1%. Meanwhile, we're going to talk to our Lizzie Burden in just a moment about UK data that came in, so I'm not going to go too much in it, but overall, UK two-year yields, they're lower by 4 basis points. They're doing kind of the opposite of what you might expect, because that data did show wages at a still uncomfortably high level. Meanwhile, the Swissy gains versus the dollar, it's at its strongest level versus the dollar since 2021. It's not just a strong dollar overall, it's partially that, but it's also because Sweden has seen lower rates of inflation. So Switzerland, rather, is seeing lower rates of inflation. So that is playing into this currency pair, seemingly in free fall. It continues to drop as we look at a CPI report on its way for the U.S. tomorrow, Crady.
Yeah, well, let's go from the Switzerland story right back to the UK. You mentioned it. We did get that employment data. Wages growing way faster than expected, hitting record high levels in the 3 months to May. Joining us now to break it all down, Bloomberg's Lizzie Burden. Lizzie, walk us through the employment story in the UK.
Well, it's a mixed picture, Critty, because you did have unemployment unexpectedly ticking up. It was expected to hold steady, but also, as you mentioned, the wage growth growing as well, past expectations. So you can see what the market is focused on. The pound's been trading up at $1.29, the highest level since April 2022, and it's still flirting with that level now. Traders pricing another 150 basis points of BOE hikes by March. That would take rates to 6.5%. So they're really honing in on the wage story. The Bank of England Governor Andrew Bailey himself has said that this is a level that is fueling inflation. Now, even if you were to tell me that that was cherry picking from the data, I would put to you the analysis from our chief Europe economist, Jamie Rush. He says, look at the unemployment numbers more deeply, and it's actually more representative of people coming back to the workforce to look for jobs rather than people falling out of jobs, and therefore it's not representative of some sort of big loosening in the labour market, which would otherwise have been a relief for the Bank of England. So when it comes to the August meeting, 50 basis points very much still on the table, following up from that last jumbo hike, but we wait for the next CPI print to really confirm which way they're going to go.
You mentioned, Lizzie, that Andrew Bailey spoke on wages. He was at Mansion House yesterday calling for restraint. I want to just take a listen to that.
The interaction of above-target headline inflation with labour market tightness and demand pressure in the economy has made underlying developments in goods and services price inflation more sticky than was previously expected. And both price and wage increases at current rates are not consistent with the inflation target. Some of that tightening is still to come through the policy pipeline, and we expect underlying inflationary pressures to recede as headline inflation falls.
Inflation is still too sticky, but it's going to fall. What was your takeaway from that?
So Andrew Bailey very keen to reinforce the message there that inflation is going to fall markedly this year. The jobs data this morning may be suggesting otherwise. But also we heard from the Chancellor, Jeremy Hunt, and the major announcement from him, which I must say Bloomberg had its eyes on beforehand, was about pension providers, that they're going to allocate 5% of their assets in default funds to unlisted stocks by 2030. That's 9 of the UK's biggest pension providers. And what I think is interesting is that this investment doesn't have to be in UK assets. Rather, the emphasis is on the benefit to pension savers. And Jeremy Hunt says that that could be £1,000 a year once people retire. We were also speaking to the Lord Mayor of London, Nicholas Lyons, on Bloomberg TV earlier. I know on Bloomberg Radio earlier. I know he was also on Bloomberg TV. But he was emphasising that this is not mandatory. And the way he put it is that that's the British way of doing things, to encourage rather than to force.
Is that the British way of doing things? So much to dive into.
Passive aggressively encourage, Critty. That's the British way.
I'm learning so much. Lizzie Burden in London, always a great teacher. Thank you. The BOE wasn't the only central bank action we got yesterday. 3 Fed officials said interest rates will have to be hiked further this year to bring inflation back to the 2% goal.
My view is that the funds rate will need to move up somewhat further from its current level and then hold there for a while as we accumulate more information on how the economy is evolving.
That's part of positioning ourselves so that we can try and get to that target level in a careful way.
One of the surprising things about the economy is just how much momentum it continues to have. We're likely to need a couple more rate hikes over the course of this year.
Joining us now is Bloomberg's Jill Deeses. Jill, what kind of clues are we getting about just how much tighter policy is getting this year? Is there really any kind of roadmap, any indication here?
Yeah, I mean, and I think you got this a little bit from the Fed's dot plot, right? But ultimately what you're seeing is more of these Fed officials really hammering home the point that we've seen Jay Powell make time and time again, which is that the Fed hiking cycle isn't over. The June pause was not the end of this cycle. I think that at this point, we're pretty much all but certain to see a hike later this month. And then ultimately the dot plot did show something, later this year as well. And that's kind of the feed through that we're getting from these types of comments. Now, of course, we're all looking ahead to that CPI print coming Wednesday. I think Bloomberg estimates have a 5% year-on-year gain, 0.4% month-on-month. So inflation still continues to be sticky. And what these guys are all trying to drive home is like, look, inflation continues to be a problem. We still think we have a little bit of room to continue to hike here. And ultimately, yes, I think that at this point, it really does have that feeling of certainty to it.
Jill, we also heard from Fed Vice Chair Michael Barr yesterday. It was literally like a love letter to capital requirements, talking about the beauty of capital to absorb losses no matter what it's from. What exactly did he introduce in terms of new capital requirements for American banks?
Right. Well, I think that at this point, Michael Barr, he ultimately is coming in here and saying, look, there needs to be more oversight. There needs to be more standardization of requirements for reporting capital and for reporting trading, operational requirements. I think that we've kind of known that he was going to be a bit more tough on regulation since he came in last year. And then as a result of that, you're going to see an increase in capital requirements for a lot of banks. What the Fed has said over and over, especially in the last couple of months, is that this is something that would likely affect, I think, the 8 largest banks more than it would affect some of the regional banks. That was certainly a concern. And this is also an issue that while we've been talking about capital requirements and oversight and standardization for years now since the financial crisis, this is something that's gained a lot of renewed attention within the last several months, particularly after the SVB collapse earlier this year. And I think that certainly factored into some of the politicization of this issue. I think what'll be interesting to see is we've got some big banking earnings coming up. I think JP Morgan, Wells Fargo, Citigroup in the coming days. More of the reaction to Michael Barr talking about these things is going to be one to look out for.
Yep, you nailed it, all those 3 before the bell on Friday. Jill, thank you so much. That is Jill Deeses from Hong Kong on the latest on Fed Speak. Now to NATO. Turkey has agreed to support Sweden's bid to join NATO in a major breakthrough for the military alliance. Secretary General Jens Stoltenberg welcomed the about turn following months of drawn-out negotiations.
Completing Sweden's accession to NATO is an historic step that benefits the security of all NATO allies at this critical time. It makes us all stronger and safer.
Now, that news came even before the NATO summit started. It's a 2-day event. It kicked off this morning in Lithuania, bringing together 31 leaders from across the organization. Joining us now is Rosalind Matheson, managing editor for International Government. Roz, again, so much has happened, and this was all even before the event started. Why did Turkey have this about face and agree to support Sweden's admission to NATO?
Well, as you say, it was very last minute after months and months of Turkey saying, no, we're not going to agree to do this. And there's a number of reasons potentially for that. One is that there are signs that perhaps the European Union is willing to have some sort of low-level conversation with Turkey about potentially joining the EU. That's been something that Erdogan has aspired to for many, many years. It is very, very difficult, but at least there are signs they're willing to have sort of some conversation about it, which is sort of a gesture to him in a way. Also, he recently won re-election, so he's very secure at home. This was something he could use during the campaign to play to his base about to get voters on board. Now he's got that. He can afford in a way to be magnanimous, to show that he's willing to consider this, of course. And the big one on the table is that the US may finally agree to sell Turkey these F-16 fighter aircraft. They've been trying for them for ages. It's been held up for many, many months. It seems like the US President Joe Biden is going to meet President Erdogan today in Lithuania and have a proper conversation about how now to get that through.
Yeah, the defense piece of the equation, crucial to that, as also as it is crucial to the future of NATO. Roz, walk us through the implications of what this means long term.
Well, for NATO, of course, this enlargement is crucial. You can see that with the addition of Finland and Sweden, you've got a ring around Russia, essentially, in sort of going into the Arctic Circle, the northern part of Europe. Very, very much going to make it harder for Russia to sort of expand its military presence there. That was a vulnerable part of NATO, potentially, in that Nordic region. So you've got Finland and Sweden likely both joining, and that sort of completes the circle in a way for NATO, and it presents that idea that NATO is a united front, very much a defensive alliance, and, you know, something that can counter Russia for years to come.
It will definitely be interesting to hear what the conversation is around Ukrainian future admission to NATO, too, as the summit goes on. Roz, thank you so much for joining us. That's Rosalind Matheson, Bloomberg Managing Editor for International Government. Coming up, the NATO summit kicks off, as we've been discussing, and we're going to be on the ground speaking to the president of Finland. And we're also going to be speaking to Matt Maley, Chief Market Strategist at Miller Tabak, later this hour. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Look, all the rage in the stock market has really been concentrated in those tech stocks. But let's put some numbers on it, on exactly how much of the contribution has come from what we're calling now, I guess, the Magnificent Seven. Of course, NVIDIA taking the top of the list is 17% contribution to those year-to-date gains. At the bottom of the pack is Alphabet, of course, higher by about 6.4%, contributing about 6.4% year-to-date gains. Again, going halfway into the year, even 6.4% is a lot, and that is the smallest of the pack. Let's put this into a little bit more perspective for our radio audience. Stick with me here. I'm going to show you a terminal chart. You can find it on GTV Go on your Bloomberg terminal. But if you look at the NASDAQ 100, of course, this tech-heavy focused index, and then you compare it to what you're seeing in those Magnificent Seven stocks, you named it, NVIDIA, Amazon, Apple, the likes, you see this massive outperformance with those tech names relative to even the NASDAQ 100, which already has that tech-heavy inclination. What's interesting, though, is a lot of people are saying this is the reason the rally is not sustainable, because it's so concentrated. The bulls would argue, well, it's backed by real money. Let's see which side of the equation Bloomberg Markets reporter Justina Lee stands on. She joins us now. Justina, walk us through this. The bull and the bear case both have, I have to say, some pretty valid points. What are we missing here?
Yeah, exactly. I think from the bulls' perspective, this totally reflects, the secular trend of the focus on AI and technological advancements again. And also at the same time, a lot of these big tech companies at this point are so entrenched in our lives that they might be less dependent on cyclical growth. But I think if you look at it from the other perspective, given how far this rally has gone and how stretched their valuations have become, at this point, they really have to deliver on those earnings in order to kind of justify those valuations. And indeed, we have kind of seen a little bit of a reversal. I mean, all this year, we've seen kind of capitalization-weighted S&P 500, like all the biggest stocks lead the rally. But this has changed a little bit, and I think it also might be tied to continued concerns about tighter monetary policy. Like at this point, with rates still probably going up, I mean, can you really justify those multiples?
Justina, you've been doing a lot of work on what's happening with MiFID right now, and it's especially relevant because we heard from Jeremy Hunt, the UK Chancellor, at Mansion House last night, talking about reforms he wanted to bring to financial markets to get people back to the UK. So for MiFID, we've had both this U-turn, as you and the team have been reporting, on unbundling research from banking, for not getting free research, essentially. If they U-turn on that, first of all, why? Why do the U-turn here? I mean, MiFID, we've been trying to enforce this thing for a few years now, 5 years or so, 6 years even.
Yeah, it's pretty crazy because a few years ago I was writing about the impact of MiFID, and now we're looking at the opposite. I mean, what MiFID tried to do was to force fund managers to pay for research and trading separately. But what seems to have happened is that really shrank research coverage, because when you have to pay for something, you might think about whether you actually need it. And the concern of EU and UK officials here is that has in turn weakened liquidity in the markets and maybe made it harder for SMEs to raise money. So now they're looking to reverse that. But I think it really is an open question whether that will have any practical impact, because at this point, MiFID is so ingrained that it's really changed a lot of practices. People are looking at research costs separately. A lot of fund managers took it upon themselves to pay for that research and now are finding it hard to add back that expense to clients. So it remains to be seen whether that really will make a difference.
Wow, you make everyone make this change and then you return and make them undo it. It's quite the doozy. Justina, thank you so much for joining us today. That's Bloomberg's Justina Lee. And for more market analysis from Justina and the team, MLive Go is where you want to head on your terminal. This is Bloomberg.
What's happening on Wall Street?
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. Kriti, want to bring us some breaking heads coming from French President Emmanuel Macron. He is speaking in Vilnius at the summit, the NATO summit, saying that they have decided to deliver new missiles to Ukraine and saying it is important to send a message of NATO unity. We're, of course, going to be going back to the summit shortly in the programming for some important conversations. Now, some other stories that caught our eye this morning. First, a few here, Kriti, to note in the UK. Chancellor Jeremy Hunt has announced an agreement between 9 British pension providers to invest 5% of their assets in startups by 2030. The government says that this will unlock £500 billion or $64 billion if the rest of the industry follows suit. To be clear, he cannot mandate that these pensions invest in UK startups because that would be a violation of fiduciary duty. So, Kriti, you got to ask, if these funds are going to be investing in startups, will they really be British ones?
Yeah, and also, is it a realistically sustainable strategy? At the core of this is really Jeremy Hunt, and I would say the entire British government trying to really bring money back to an innovation kind of sphere in London that, of course, has, post-Brexit, seen a lot of flight.
Yeah, and we just got that wage data. The economy is still an issue, so maybe that needs to be solved first. Well, sticking with the UK, another story we saw, bankers in London saw their bonuses dip across the board amid a deal-making drought in 2022. VPs made 13% less, and all but the most junior associates saw their total compensation reduced compared to a year earlier. That's according to a survey done by the consultancy firm Dartmouth Partners. Ouch. Gotta feel for him, Kriti.
Yeah, but you know what? I gotta say, cutting bonuses is perhaps a minor step relative to perhaps the layoffs you've seen across Wall Street. So
yes,
perhaps a preliminary step, but something we gotta watch for sure.
Yeah, such a good point. Would rather lose out on a bonus than lose out on a job. Just quickly, over on Wall Street, while the deal-making drought is ongoing, one good sign, banks, including Citi, JP Morgan, HSBC, and UBS, are said to be working on approaching international investors for Syngenta's $9 billion IPO in Shanghai. It'd be the biggest of this year. It comes after the Chinese-owned seed giant won regulatory approval for the world's biggest potential listing this year. So, hey, some signs of life coming to this IPO market. All right, coming up, we're going to be live to the NATO summit where we're speaking to the president of Finland next on Bloomberg.
Forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A still hot labor market. UK wages rose more than expected in its latest reading, keeping the pressure on for higher interest rates. The data equaled the highest level on record last month and in 2021. More work to do. Fed officials say higher rates are needed to bring inflation down to 2%. Barr, Daly, and Messer all call for additional hikes this year, while Bostic says be patient. And the NATO summit is in full swing over in Lithuania. Sweden wins its final backing needed from Turkey to join the alliance. I'm Kriti Gupta in New York with Danny Berger in London. A lot of geopolitics to digest, Danny, but I feel like the action still in the bond market. It's all about the eco data. It's all about the monetary policy.
It really is. I mean, we've heard from ECB speakers, from Fed speakers. There's been so many Fed speakers. We're about to get the blackout period, so that accounts for this deluge that we've gotten this week. Kriti, one interesting aspect, I think, to cover on this European market, and we're really going to see it when you bring us to the American board, is the outsized impact that China has on Europe, specifically Chinese growth. Now, that story hasn't really been in play at all this year, but we did get some signs of hope in today's session, early morning for Europe, overnight for the U.S., that Chinese authorities would be supporting the property sector more, and that ignited hope of more stimulus. That has really played through Chinese sensitive stocks, the LVMHs, the French luxury goods. So overall, that European index is being brought up by those, up 0.25%. Basic resources, again, this is the China story, up more than 1%. In general, basic resources, the actual commodity themselves, are higher today. Meanwhile, the UK two-year yield is falling. We're buying the front end, matching what's happening in treasuries despite too hot wages coming in, wage growth at 7.3% in the UK. That was the data this morning, matching the high estimate we had last time around. And finally, the dollar in free fall versus the Swiss franc. Switzerland has a much more benign inflation picture. The Fed, as we heard from officials, still want to hike, Kriti. Weaker dollar versus the Swiss franc off the back of that.
Yeah, it's interesting that we talk about that weaker dollar and a positive story for the European markets, because it's starting to seep into the U.S. session. That was not the case about 30 minutes ago. Futures now marginally in the green. 44.45 is what we're looking at on those contracts. The bond market on the front end of the curve catching that additional bid. We're now down 3 basis points, 483 on the front end of the curve. You mentioned that dollar weakness. The yield story also pushing the green back lower. What's interesting is that the commodity index is higher broadly. Gold, copper, oil, it is all higher this morning. I wonder how much of that is simply a consequence of that weaker dollar that we were seeing. So some real ripple effects at a time when, of course, in the Asian session, you really saw some real outperformance coming off that Chinese property stimulus. I want to get to some of that earnings story, though, because, again, we're talking a lot about the bond market. We should mention earnings season does kick off on Friday as well with JP Morgan specifically. So there is a lot to digest on that front as well, which brings me to a chart for our radio audience. Stick with me here. We are looking at kind of how you navigate the market. This is essentially the Citigroup U.S. Earnings Revisions Index. This was essentially Danny's chart. I am taking over, but we are seeing earnings downgrades actually pick up. You're saying that that margin value, essentially, that has been powering a lot of these stocks, not just in the tech space, but broadly, may not hold enough water. And that's a warning that you're hearing from a lot of strategists, which is kind of creating this lower earnings outlook from a lot of the pros on Wall Street. Joining us now is Matt Maley, Chief Market Strategist over at Miller Tabak. Matt, is this a fair chart? Is this earnings outlook, this kind of doom and gloom that we're starting to see, in line with what you're hearing in the marketplace?
Yes, definitely, Kriti. And one of the things that, we have to kind of been pushed to the side in the last month or so is this whole thing with the regional bank crisis. It didn't create any systemic issues, but it is going to create economic issues. Whether it creates a recession or not, with the market as expensive as it is, it doesn't really matter, to be perfectly honest. With the market, like I said, if these earnings cannot come in a lot better, and that's going to be a lot harder to do with these banks pulling in their horns a little bit, we're going to seeing a certain amount of credit contraction. That's going to be tough for earnings to grow to the manner that we need in order to get the stock market to rally further from this expensive level.
Talk to us a little bit then about how you value something like that. I mean, historically speaking, when you see this much green on the screen in the front half of the stock market, the back half tends to follow. Why is this time different, and how do you even put a number on that from a valuation perspective?
Well, that is hard to do. There's no question, and you're absolutely right. The history says when the first half is good, the second half can be better, or is. I mean, not necessarily as good, but certainly good and doesn't give back. Although we certainly have had some tough examples. I mean, I'm not saying we're going to have a repeat of 1987, but the 1987 ended up being okay, but we had a 30% decline in the middle of it. But more importantly, is that one of the reasons that the market really took off in the further in the first half of the year was this big injection of liquidity from the Federal Reserve and other central banks during this regional banking crisis, and that's starting to pull back. I mean, the good news is that we didn't have a major run on the banking system. We didn't have a major banking crisis, but now that liquidity is being pushed away, as we can see now with the Fed's balance sheet starting to shrink again, that gives us less fuel to really fire the kind of underlying rally that we would need to. Underlying growth in the economy that we would need for another good half in the second half of the year.
Matt, does a bear steepening in this yield curve bring concern to you? This is not a market pricing in cuts. This is a market expecting higher rates. I know it's not happening today, but it did happen to end the week last week. Is that a concerning development and change in this bond market?
Yes, Danny, I totally agree, because we're seeing that the 2-year note is up. Well, tested 5% last week and actually got above it for a short period of time. But the 10-year note is rising more quickly, so the yield curve is steepening. And most people might think, well, geez, that's really good, right? Because when the yield curve becomes inverted, that signals a recession, and that's negative. So when the opposite happens, that must be positive, right? Well, actually, no. When you get and the yield curve becomes inverted, and you go all the way back to 1980, every single time that the yield curve has gone from an inverted situation to where it steepens back up into positive territory, that's actually when the worst of the market, the worst of the market turmoil takes place, and not just in the stock market, but in other markets as well. So again, we've only had a steepening here for a short time. This might be a little bit of a head fake, and we've had a few of those in the past. But if we see a significant steepening of the yield curve with the 10-year yield staying higher than or rising higher or staying higher than the 2-year, that's going to cause a problem for the marketplace, not be positive for markets. And it's something I think a lot of people don't really realize right now.
Yeah, a lot to digest on the market front. Matt Maley of Miller Tabak, always a pleasure to have you on the show to break it all down. And a crucial time when market pricing is front of mind. Also front of mind is the geopolitics, which brings us to global leaders gathering in Vilnius, Lithuania for the NATO summit. Bloomberg's Anne-Marie Hordern is on the ground. Anne-Marie.
Thanks, Critty. A really historic day as we have Sweden overnight being able to have this path to join the alliance, with Turkey doing this U-turn. And I'm now joined by Finland's president, Sauli Niinisto, an architect, really, of both Finland and Sweden joining the alliance. You're one of the key diplomatic architects of this. You've been very close in terms of negotiations, obviously, of Finland joining, but also of Sweden joining. What do you think broke the impasse last night between Turkey and Sweden?
First of all, I don't feel like an architect. I have been working with all our friends to the same direction, so to get Finland and Sweden in. Now we have a green light, at least to some extent, and I have strong belief that we will see Sweden quite soon as a full member, and that is surely important for us. What actually happened, we don't know yet, but
maybe F-16s from Washington?
Maybe, well, we have heard rumors and also news that F-16s have been under discussion by President Biden and President Erdogan. That has been, in a way, at the table all the time during this more than 1 year's process. So, but wait and see.
With Finland and Sweden now both almost likely, almost there in the in the alliance, you have almost an uninterrupted control now, NATO, of the Baltic Sea, barring potentially Kaliningrad. There's also the question about the Åland Islands. These are your islands. They are demilitarized, but there is a Russian consulate on these islands. And this is a place that Russia is able to monitor the Baltics from. Should this remain demilitarized now that Finland is in NATO?
Yes. First of all, how we see is that after our Finland and Sweden joining NATO, the Baltic Sea will be peaceful, to guarantee peaceful and peace for Baltic Sea countries. That's the idea. Then to Åland, we have to keep in mind that the demilitarization is based in Paris peace agreement after Second World War. And there are a lot of countries involved. So that would be an issue to open actually Paris peace negotiations. But the consulate, well, we have to keep in mind that there's one consul and his wife, nothing else in that consulate in Åland. But at the moment, question of consulates is very updated because Russia has announced that
they're shutting down your consulate.
They are demanding us to put down our St. Petersburg consulate. They have in Turku, which is actually serving the Åland small consulate, but in Turku they have a bigger consulate, and that would be well, similar than St. Petersburg. But we haven't made a decision yet. It's quite a new event.
But would closing the Åland Islands consulate be on the table as well as Turku?
We will see. At least Turku is clearly at the table.
And what do you think of the fact that polls in Finland, when you do the polling of your population, there's actually growing support to make those islands militarized instead of keeping it in this demilitarized treaty?
Like I said, it's a question of Paris peace agreement, and on the other hand, it seems that people in Åland are strongly against any militarization there. So we have to understand also that things have changed since 1940s.
Yeah.
You can now protect an island from outside. We have missiles, whatever. And on the other hand, Russians can very well control by satellites the island of Åland and, well, the whole Europe, actually. So things have changed quite a lot from those days. Mm-hmm. And this is one element we have to, well, keep also in our minds when we make decisions.
For the time being, Finland is not hosting any NATO troops. At some point, will you give your consent for that?
Well, you have to keep in mind that we are also negotiating with the USA about a direct defense cooperation agreement, and that would include some American presence, like in other countries they have a similar agreement. NATO presence is surely very important, but whether it is a permanent presence, that's another issue. It seems that, well, Finns don't see that as a primary question.
Putin has said that he isn't as concerned about Finland and Sweden joining NATO the same way Ukraine, if they were to, because there's no territorial dispute. But if there was changes in the infrastructure, he would respond in kind. Are you concerned about any blowback from Russia if you were to put NATO troops on Finnish soil?
Actually, we were expecting, and I was very careful with that last year, whether there are reactions from Russian side. None of them then. But like we discussed, now they are closing our consulate. Now they have started to put push on us. I do not, they are fully aware about how NATO is behaving and fully aware how Americans are, due to that agreement, cooperation agreement, behaving. So there's nothing new for Russians in whatever we do.
With the path now for Sweden, now given the green light by Turkey, obviously the big conversation here at NATO is what happens with Ukraine and their path forward.
Yes.
President Biden has said there's no unanimous consent amongst NATO members about Ukraine becoming a NATO member. Would Finland support Ukraine becoming a NATO member?
First of all, I think it's important that we have now already tabled one victory, that's the Swedish membership, and it gives an impression of united NATO. Yes, there has been discussion, and according to my understanding, there are ongoing negotiations where we could find a compromise, a clear, united statement on Ukraine to NATO.
About their path forward to become a member, or how their dialogue and protection is regarding the alliance?
That's another issue, and surely the path somehow will be described. My opinion is that we should give all the possible help for them to meet the conditions of NATO. Then the other issue is that they would like to have some kind of security assurances. We know that in G7 group, they are also discussing on that.
Yes.
And we, according to my knowledge, we will get more information in a couple of days from G7 too. So let's see how it will be formulated and what we can do for that.
I want to ask you also about what's going on internally in Russia.
Yes.
You've been dubbed in America the Putin Whisperer, but it's because of your years getting to know and having a dialogue with Vladimir Putin. What we've seen over the past few weeks, this halted mutiny by Yevgeny Prigozhin, and then reports that, it's actually the Kremlin saying, Putin then held almost 3-hour talks with Prigozhin. What do you make of this fracture within the apparatus of the Russian elite and Putin and his closest, what would have been his closest allies?
Yes. Well, first of all, it's amazing that something like that can happen in any country, and especially in Russia, that, well, was it an attempt of a coup? we don't know, but nevertheless, marching on the capital with military forces, that's quite amazing. I have, well, not any better understanding what happened and what's going on, but you referred to the fact that Prigozhin and Putin have been at least very long, somehow together, maybe friends, and that might have an impact on Putin's behavior. Who knows? Well, it didn't seem to have very much friendship impact on Prigozhin's behavior.
Yes.
But yes, it raises question about leadership in Russia, but on the other hand, we haven't seen any clear signals that something would be going on.
Okay. You've also had a lot of access to President Biden. Last time we met in Washington, that was your 6th time in the Oval Office, which is quite a lot for a much tinier country, especially look at GDP and scale to the United States. Given the fact that you, out of all these world leaders here, you probably have spent the most time with both of them, Biden and Putin. And right now in America, obviously, we're gearing up for an election next year. And poll after poll continues to show that Americans are concerned with President Biden's age. What is your interactions like with him?
Well, I know him from a longer period. Before I was president, I met him first times. I think that President Biden is a man of peace, and that's a very valuable attitude in days like this, when we are all worried about developments worldwide. Ukraine is not the only place, and surely we have to look very closely. Russia, China, the BRICS countries, whatever is taking place. So this is my opinion on President Biden. On the top is that I consider him as a man of peace.
And he's headed your way next.
Oh, yes. Yes, he is coming to Finland after this meeting. We are continuing an old tradition, actually, that the 5 Nordics meet U.S. President. President Obama started it, and now we can continue it.
Sauli Niinisto, thank you so much for your time.
Thank you so much.
Kriti, that was the president of Finland, Sauli Niinisto, a key architect in terms of Finland and Sweden joining the NATO alliance.
And Maria Horder there with a crucial interview at a time when, of course, we are monitoring the NATO summit and the developments out of there. Geopolitics top of mind, so is the markets. Coming up, a look at some of the market-moving events to watch throughout the day. Stick with us. This is Bloomberg.
What is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Sellers are less eager to sell in an environment where they can't get the best price, and certainly rising interest rates have made it harder to justify higher prices, and so there are fewer deals available.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Let's get you set up for your trading day and a look at what is ahead. NATO's annual summit is in full swing in Vilnius. We were just there speaking to the Finnish president. A press conference from Secretary General Jens Stoltenberg will take place at 10:30 a.m. Eastern Time. Then President Biden and President Erdogan will meet at 11 a.m. Likely top of the agenda is the JETS negotiation, which is part of what Turkey wanted in order to approve that Sweden entry to NATO. Now, over in the U.S., a Senate hearing for the PGA Live Golf deal is scheduled for 10 a.m. with Live Golf CEO Greg Norman set to testify. Also, finally, the Sun Valley Conference will be kicking off in Idaho with some of the biggest names from tech, media, finance, and sports all gathering for the Billionaire Summer Camp. Critty, what you looking at?
Yeah, a lot to digest there. You mentioned some of the big media moguls, some of the big tech moguls being at Sun Valley. Well, that brings me to Amazon shares and how they're trading in the pre-market. You're already seeing a little bit of green on the screen because at the end of the day, Danny, it is Prime Day, higher by about 0.5%. Traditionally does give the stock a little bit of a boost, but we'll of course see if that holds throughout the rest of the session.
Can I just tell you, some of these headlines came through on the Bloomberg terminal about Amazon suing the EU. Now, they've been sued after being earmarked for the Digital Services Act. This act essentially says that there are certain tech companies, Amazon being one of them, are big and systematically important. Therefore, there are more controls placed on Amazon and certain checks and due diligence they need to do. Now, Amazon, as a part of this lawsuit, has contested the label of a, quote, very large online platform by the EU. If they're not a very large online platform, Critty, what is then?
Yeah, I'm excited to see the legal argument surrounding that one. Of course, that's going to be something that the EU is going to have to define, and that's going to go back and forth as well. But for right now, still not moving shares to the extent that I think we would expect. To the downside, though, Danny, we do have another name in the news. Uber's CFO specifically resigning. Look, he's stepping down after a 5-year tenure that took Uber to its IPO. Nelson Che has not talked about timing yet, about when he's going to step down, but has informed, of course, the CEO and the team that he will be, something that the market is not responding to very well, down about 0.9% on those shares.
Yeah, I think this is one of the biggest C-suite departures since they went public, so definitely a big change there.
Yeah, a massive one. And speaking of departures, we got to get a quick check on Microsoft as well, because there is some speculation out there about whether or not they're going to go back and have another round of layoffs in addition to the 10,000 they've already announced in the last year or so. So those shares marginally higher by 0.1%, but again, that reporting not confirmed by Bloomberg just yet. So keep an eye on those big tech shares. That does it for early edition. Surveillance is ahead. We've got an all-star lineup. Jason Trennert of Strategis, Win Thin of Brown Brothers Harriman, and Brent Schutte of Northwestern Mutual all join the show. Stick with us. This is Bloomberg.
do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg.
I don't feel like the market's been crazy. I do see the potential for some upside.
The markets are being very rational.
Investors have been investing in a new regime from the last 10 years.
Maybe the Fed's not fighting as big of an inflation problem as we thought just 90 days ago.
As we're heading into the end of the year, we do think things start to slow down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Stay in bed. The week begins tomorrow. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures just about turning positive on the S&P 500. You want us to be honest, don't you? CPI data tomorrow morning, PPI after that, then Tom, earnings season begins.
It's a terrible churn of the market today. You really see it. We'll do it through the data, equities, bonds, currencies, commodities. But what it really is to me, John, is setting up this arch battle beyond the inflation report to the beginning of earnings season. We start strong today with Jason Trennert of Strategas, where you want to be in the market, but how are you in the market given all this news flow?
Well, let's spice it up. 7-handle wage growth in the United Kingdom. A problem only if you're an economist. I love this language by an economist that's quoted in our story. I won't cite them directly, but I'll use their language. Pay growth remains uncomfortably high. Bramo, things only economists say. Can you imagine going into your annual review and saying, I'm sorry, pay growth remains uncomfortably high, and I think that maybe you shouldn't give me
That's what the governor wants.
That's what they want. Exactly. That's what the Bank of England officials
I
are basically saying. They're saying, please, guys, ask for less. And that's sort of this very uncomfortable truth that people are rejecting.
Is a generalization, John, it's just a Keynesian madness. I'm using that word not in a formal basis, but it's a throwback to the middle of the 20th century and then the inflation of the 70s. And it's like greedflation. I just don't buy it. It's bad math.
Every man for himself, TK. You go into that annual review. Good luck to you.
Yeah.
Okay. That's later this year.
But 7%, that's a big number.
It is a big number for the Bank of England, who maybe are going to hike 50 basis points once again, Bramo. We thought this was over a couple of months ago. Peak rates. Trying to go into that pause phase, and it doesn't seem that's the case at all.
That, to me, is the theme of the week, especially with some of the rhetoric that we heard out of Fed officials yesterday, not only in England, but you're seeing in the U.S. a similar tone that perhaps they've got to go further in order to bring inflation under control. Question in the U.S. of whether inflation is starting to roll over more significantly and whether it's sustainably so. In the U.K., it's another story, and that's the difficulty at a time when they are seeing some sort of hit to the economic growth.
What I'm going to do is look at the bond market. I think, equity people, I think Jason Trennett will agree with me, is you've got to right now holistically look at the dynamics, John, of the bond market, of spreads, of the real yield. And even on a boring Tuesday, you've got to really parse that and say, yields have come in over the last 3 days.
Lisa's going to make this less boring in just a moment. I'm going to whip through the price action for you. Just quickly, briefly, on the S&P 500, we are positive by 0.1% on the S&P. At the front end of the yield curve, I've got the 2-year yield down for a third straight session. We are down by 3 basis points on a 2-year. On a 10-year, down around about 4 basis points. Lisa, that yield on a 10-year maturity in the Treasury market, 395.21.
I'm laughing because I'm thinking you can write in and say, do you want more honesty? Do you want less honesty? Please deliver your input. What we're watching today is a number of really important events, including the NATO summit, which is kicking off in Lithuania. This morning, we've already seen President Biden meeting with the Lithuanian president. He's going to be speaking with Jens Stoltenberg shortly at 11 a.m. You have Erdogan of Turkey also meeting with Biden. Very curious to hear what some of the arrangements are with F-16s, as well as other types of provisions for Turkey in order to ease some of the other discussions. Starting today through the week, Sun Valley Conference on the future of new media, as well as entertainment. Last year was all about Twitter. This year, Elon Musk will not even be there. Meta platforms very much in the center with the Threads advent. We have seen Meta shares up 144% just this year. And then later on today, what we are looking at is Amazon Prime Day, which no one cares about, essentially. No one's talked about it, which is interesting, right? To me, this used to be a major false advertising holiday that we used to knock down.
What was false?
Well, it's just the sort of like drumming up confidence, drumming up enthusiasm for this. And now what you're seeing is a whole host of competitors of Amazon trying to get in on that, having sale days, not relying on it as much. You're seeing a slowdown in terms of the gains.
Very scientific. Can I just say the pile of boxes at my walk-up, it just gets bigger and bigger and bigger. I mean, I just the absolute unit growth of Amazon, I don't see any end in sight.
Deals for you. Got 40% off some golf clubs if you want them, Tom. 20%.
Prime Day?
Yeah.
And
I've never done Prime Day.
One of the best deals from Wirecutter of the New York Times.
What is it?
Roomba.
What's that?
The sort of personal vacuum cleaner that just goes by itself.
Oh, yeah. Right.
I was very excited.
Jason Trennett once called me up and he says, Tom, Amazon Prime.
Up to 50% off an iRobot. Is that?
Yeah, that's exactly it. Yeah.
It's an
I was
iRobot.
kind of excited about that.
Oh, yeah. Roomba, vacuums, Brava Mom. Okay, cool. Look forward to that a little bit later. Jason Trennett joins us now, Chairman of Strategic Research Partners. Jason, wonderful to catch up with you. Let's talk about the week ahead. Inflation data tomorrow, bank earnings on Friday. If you had to pick one right now, what would you want to see immediately?
I think you'd want to see lower inflation data, and I think there's a good chance you're going to get it. This is the easiest comparison for CPI probably of the year because you peaked in July of last year. And so this is a good one. This is probably, hopefully we get a good one, because if we don't, the comparisons are going to get tougher from here. Banks, the thing I would say, Jonathan, is that the expectations are relatively low already. And so, and I think there's a decent chance the banks are going to beat those lowered expectations. But to me, the CPI number is a bigger, looms larger over the market this week.
Jason, you were doing quality before quality was in. And the basic theme of Jason Trennett has been, you got to be in the market. You can't go in and out. You got to participate, but you've always got to participate with quality. Where is the Trennett quality right now?
Well, and I would say, Tom, as you know, there are times that worked out better than others. So it worked well last year, but it hasn't worked particularly well this year, in my opinion, just given the valuations of the market. But I feel very strongly about that now, because I just don't think the valuations of the overall market are particularly compelling. I think the risk reward is actually quite poor, given our expectations for the economy and for earnings over the next year. Market's really trading, depending on the numbers you're looking at, but it's certainly trading at 20 times trailing, and it's somewhere between 19 and 20 on forward earnings, depending on the earnings that you're using. I think that the earnings expectations for 2024, in my opinion, are much too high, at up about 12%.
So how much cash do you have? I can't believe I'm having this conversation. Or is there a Trennett cash hoard?
Yeah, we have a balanced portfolio, or we have a model portfolio, and we have 6% cash right now, which is at the upper end of our range. I think it makes some sense, again, given where the valuations are.
We started this program, Jason, talking about how it's a sleepy summer and people are taking a break. Not a lot is going on. How are you resetting at a time of perhaps a pause, a little bit less dramatic volatility in terms of bond yields, in terms of stocks, to shift your allocations?
Well, listen, I think that in the end, I think that stock prices are largely about interest rates and earnings. And I think people should just take a step back. There's obviously been some performance chasing, I would say, at the end of the first quarter, particularly as it relates to AI. I understand that. I wouldn't stand in front of that. By the same token, though, I would kind of take a step back and really start taking a look at 2024 earnings for the market as a whole. So when the earnings season starts here, I would be paying very close attention to what the guidance is going to be, because the sell side has not really taken their numbers down. Earnings expectations for 2024 are down about 3 or 4% year to date, but the market's up 15. And now you have a situation where 10-year Treasury yields are piercing through 4%, more or less. And that's just not consistent. Multiple expansion is not consistent with those sets of facts. And it seems to me there'll be some comeuppance if we continue on this path.
Over the past week or so, there was a new paper out by a Fed economist who said that a lot of the gains, about 40% of them in stocks over the past couple of decades, has just been a mechanical explanation based on what we've seen from rates, based on what we've seen from companies able to take those low rates and just put it into higher profits. Do you think, as this Fed researcher thought, that going forward, there is going to be a mechanically lower rate of return from equities just generally? Is that kind of how you're arranging some of your portfolios for the longer term?
Now, I didn't read the paper, but I am very much sympathetic to the concept that it's going to be difficult to reprise the certainly quantitative easing and almost negative real rates for 12 years. So as a result, the forward returns, one would have to think, are going to need to be lower. I am of the view that quantitative easing for 12 years was an enormous policy error that we're going to have to deal with for a long time. It means that you're probably going to have higher interest rates and higher long-term inflation for a very long period of time, and that puts pressure on multiples. It also makes it harder for companies to buy back their own stock. It also makes it harder for private equity firms to be as involved as they've been. So there's a perfect storm in a way in which, as I said before, stock prices are largely a function of earnings and interest rates. If you peg interest rates at negative real rates for 12 years, it's not surprising that you've had an enormous expansion in multiples and in the market itself.
Jason, if people got lucky and they bought Trinity Quality, and let's say it's in tech and maybe they own some of the 7 stocks, should they sell them?
I just wouldn't be adding a lot from here, and I try to tell you, what I'm doing myself. I always think with strategists, you should always ask them what they're doing with their own money, because it cuts through a lot of the nonsense. And I'll be very candid. I haven't sold a lot, but I also haven't added a lot, certainly from the start of this year. Now that might have been, that's been my mistake. Market's up, S&P's up 15%. But again, I have a longer-term time horizon than perhaps a professional money manager might with my own money. A professional money manager obviously has to also worry about staying employed, and so that's a whole other dynamic that comes into play. But for those with longer-term time horizons, I certainly would be careful about chasing performance, and I would also take a really hard look at the valuations, what you're paying, what the risk-reward looks like for the companies that you're buying. There's still, believe it or not, about 40% of the companies in the Russell 2000 that have not had a profit in the last 12 months. Now, that's sustainable when interest rates are negative in real terms, It is not sustainable when rates are going to be positive in real terms. And we could debate whether they're positive in real terms now. I don't think so, but we're getting there. We're going to get there. And that just changes. I think that changes everything.
Jason, appreciate your insight. Thank you, sir. Jason Trennett there of Strategas Research Partners. Just the latest there on the markets. Here's the latest on NATO. Just a bit of reporting from the team here at Bloomberg, led by Alberto Nardelli this morning. A group of Ukraine's key allies are closing in on an agreement to launch negotiations with Kyiv on a collection of bilateral security commitments aimed at bolstering the country's ability to defend itself. Allow me to give you a little bit more information about what that is. The US and other participating nations would each work with Ukraine on specific long-term security commitments, Tom, through the provision of modern military equipment across air, land and sea, prioritizing air defense systems.
I think for people just diving into this, there's the Ukraine-specific, what are we going to do as allies? And Mr. Stoltenberg, who I believe we're going to hear from, will mention that. But, John, I'm going to take the polarity here of what's going on in the Baltic Sea with Finland in NATO, Sweden on the cusp of being in NATO. I can't believe I'm saying that. That's so foreign to anything I was ever educated on. And then I'd swing it all the way down to the southern front and Mr. Erdogan's unique pressures with Turkey.
That reporting this morning, according to people familiar with the plans. We are waiting some comments from the President of the United States alongside the NATO Secretary General. Those comments, we're told, are imminent. Let's get to AMH on the ground over in Lithuania. AMH, give us the latest on the reporting here at Bloomberg.
Well, I think what we really want to hear is from President Biden on what he has to say regarding what happened overnight. Within the last 24 hours, we have a completely different outlook on what we are going to be able to see coming out of this NATO meeting, and that is that Turkey is really paving the way for Sweden to be the next member of NATO. It was going to be these two Nordic countries, but really on a dual track. But Finland was able to make that ascension first. Now it does look like Sweden will also be able to do that. And it does look like this is potentially because of F-16s that might be coming from the United States. This has been widely expected, and there is a lot of reporting that there's also been some pressure on Bob Menendez, the senator from New Jersey and the chair of the Senate Foreign Relations Committee. So that's really one key and really important topic here on the ground. And I just spoke to Finland's president, Sauli Niinisto, and he was saying that that's really what the rumors are about in potentially for this quid pro quo. The White House is not going to call it that, but let's say it what it is. The second big topic here, of course, is what happens with Ukraine. Ukraine wants to become a member of NATO. Now, President Biden has already said there's no unanimous consensus on NATO members regarding when Ukraine could become a member. There's obviously a war on Ukraine territory. They would want to become a member right when the war, they say, ends. There's obvious concerns about a frozen conflict, though. So what you're trying to see here and what leaders are going to be talking about is what is the path forward in terms of their dialogue with the NATO alliance, as well as some of the security commitments Ukraine wants to see from the NATO alliance. And just like Zelensky made this push for more support at the G7 in Japan, he is going to be here as well at the NATO summit tomorrow.
Anne-Marie, one outstanding issue is the provision of cluster munitions. What are you hearing on the ground there about who's pushing back, who's supporting it?
Well, it's difficult. This is a difficult one for the likes of France, Germany, Italy, especially some of these countries that have signed up to a treaty that would ban the use of cluster munitions. What we continuously hear from the White House is that Russia is, though, using these bombs, and the dud rate or the failed rate on these bombs is much higher in Russia than the U.S. says they would send.
AMH, thanks for that. You can see on the pictures right now the NATO Secretary General, Jens Stoltenberg, speaking alongside the President of the United States. Let's take a listen.
Also send a clear message to Ukraine that we stand by them as long as needed, and also that we agree on united and positive message on the path forward for Ukraine and membership for Ukraine. United and positive message on the path forward for Ukraine and membership for Ukraine. Another major message from this summit will be that we need to invest more in our defense. And we will agree a new defense investment pledge, where we state clearly that 2% of GDP for defense is a minimum. The good news is that European allies and Canada are stepping up. This year, we have new numbers showing that they have added 8.3% in real terms for their defense budgets. This is record high, and that demonstrates that allies are delivering on their commitments. So once again, Mr. President, it's great to have you here at the NATO summit.
It's good to be here, and thank you. Continue to deliver. As I've made no mistake, the press is not at all surprised. I've been touting the fact that I think it's really important at this critical moment in Ukraine, in the whole NATO issue, that you continue to lead NATO. You're trusted. No one knows the situation that we're facing better than you do. And this is a historic moment. The adding of Finland and Sweden to NATO is consequential. And your leadership really matters. And we agree on the language that you proposed relative to the future of Ukraine being able to join NATO. And we're looking for a continued united NATO. They've heard me say, my American press has heard me say many times, I still think that President Putin thinks the way he succeeds is to break NATO. I'm not going to do that, especially with you as leader. So thank you for the willingness to do that. Thank you. Thank you all.
Mr. President, what is your role in getting Turkey to agree, Mr. President?
The President of the United States alongside the NATO Secretary General. Some brief comments there. In around about 42 minutes' time, the President of the United States attending the meeting of the North Atlantic Council. A little bit later on this morning, so at about 11 Eastern time, you'll see the President of the United States at a bilateral meeting with Turkey's President. The provision of some F-16s, a key focus for many of you. I know, TK, so that's the latest this morning.
And some bargaining going on there. You've got to believe that we'll give you F-16s if you will, da-da-da-da-da-da.
It seems to be the nudge, nudge, wink, wink in the last 24 hours.
I like that. Nudge, nudge, wink, wink. There's a lot of nudge, nudge, wink, wink going on. Right now, your brief of the morning on what we see in Lithuania. Julie Norman joins us, co-director of the UCL Center on U.S. Politics. Julie, I want to go back to an essay that Condoleezza Rice and Robert Gates wrote in the Washington Post 6 months ago. And they talked about what has changed here is, without question, Ukraine has proven that they are a determined partner. Are they already now part of NATO, even though they await admittance?
Well, Tom, that's certainly going to be the big question for NATO this next 2 days, and figuring out what is the next steps for Ukraine. We just heard in the statement from the president and from NATO that there is a general support for Ukraine membership. But what that actually looks like and what its timeline looks like is still very much being debated within NATO. And as you referred to, there's been some indications that Ukraine is stepping up and meeting some of the military requirements that are sometimes expected, but Biden and others have still have reservations about their political and some of those pathways forward. But the big question is just how can you move forward with this during a war? And so for Biden, for Germany, for some of the other actors, there's a sense of not pushing this timeline up while this conflict is still ongoing.
It feels like NATO members are flirting with how much support they can provide Ukraine without creating an escalation to the war, without creating sort of an inadvertent inclusion of NATO members in the conflict with Russia. Where is that line, Julie?
Well, it's something that has been debated throughout, and we're never sure exactly what's going to be a red line for Putin. And I would say the Biden administration has really been trying to ensure that this conflict does not become a World War III, does not escalate further. Where this ties in with the NATO membership, though, is NATO obviously has the clause that an attack against one is attack against all. So essentially, the idea is that if Ukraine was brought into NATO officially, while this conflict is still raging, would that then commit the U.S. and the rest of NATO to being directly involved in a way that most are not quite ready to be? So that's where that tension stands. At the same time, if you say, okay, we'll do this right after the war ends, in some ways that just gives further incentive for Putin to continue the war indefinitely.
The war has been going on for about 18 months. We're coming up against that unfortunate benchmark. A year ago, Julie, at the NATO meeting, people seemed to be very united. There was a commitment to support Ukraine. There's a very different tone at this NATO meeting. How much is this issue polarizing and dividing some NATO members that had had an unusual degree of unanimity last year?
Yeah, I would say, NATO is going to try and come out of this summit with an equal sense of cohesion, of unity, and they really see that as as a crucial message to send to Putin, if no one else. I would say there's definitely differences, but overall, most countries are still very committed to supporting Ukraine. It's what exactly that support looks like. Differences on what kinds of weapons are being sent, when they are being sent, this question of membership. But in general, this idea of supporting Ukraine is one that most NATO states are still pretty strongly behind.
Julie, in the arc of the last number of months, we have the shock of Finland joining NATO, maybe Sweden joining NATO, maybe Ukraine joining NATO. This is the exact opposite of what Mr. Putin wanted. How will he respond?
Well, Tom, it's one reason that I think there was some reluctance initially to consider this, but the alliance has pretty much decided, look, in the long run, this may be the best way to deter Putin, is to have the alliance expanded in this way. What that actually means for Putin, I think, is anyone's guess. We saw after the 2008 NATO meeting in Bucharest, which first suggested that Georgia and Ukraine might have a path to membership. Many cite that as when Putin started thinking in a more pugnacious way. Others see, again, this expansion is quite necessary. So I think it's debate that's going to be ongoing.
Julie, thank you for your input this morning. Julie Norman there, the co-director of the UCL Centre on US Politics. TK, absent in this conversation through the whole of this morning, and I would say for the whole of last week, is how this war concludes in Ukraine. What is the path to some kind of resolution?
I would say the real focal point for me is clearly the reports, particularly out of the British press. I think they're more on the scene, if you will. It's in a World War I equivalent, where they're arguing about 20 kilometers, 12 miles of territory.
Well, and the problem is that people in quiet conversations are saying it just drags on, and it's just a war of pain that goes on for a very long time. And that's unfortunately what NATO members are kind of counting on, because Putin is not going to just give up. And this is the problem. And so how do you support a nation while they are dealing with something that is a World War I equivalent in a world that has moved on to very different types of war methodologies?
It's already gone on for so much longer than people anticipated 12 months ago. If you are just tuning in, welcome to the program. Our coverage on NATO will continue. That summit, of course, taking place in Lithuania this morning. On the ground, Maria Tadeo and Anne-Marie will catch up with them through this morning. David Page of Extra Investment Managers coming up very, very shortly. We need to reset and look ahead to the data this week, CPI, PPI, all that inflation stuff. Then on to earnings, JP Morgan, Wells Fargo, Citi. A lot of people, Tom, expecting maybe some increase in loan loss reserves at some of these banks, and maybe writing off some loans as well. Will we get some insight into those cracks into the economy that people have been looking for?
And not only the big banks, which will start reporting on Friday, but, John, right down to the regional, the super regionals, and then regionals, and then, of course, all the debris off of SVB. It's not just one set of bank earnings this time around.
And I think that if they do show some sort of retracement or some sort of also increased requirements from regulatory action, what does that do in terms of setting the tone for the rest of earnings?
These guys talk at the moment, the more revealing that splintering on the committee, Tom, is becoming.
Yes, absolutely. And what do we have, 6 Fed speakers today?
I think so. Bramo knows off by heart. What have we got, Bramo?
Actually, I haven't seen it as much as yesterday. Yesterday was really the bonanza.
Yesterday was it?
Yeah, that was it.
They're all recovering from a home run derby.
We could have parsed through the words.
Equities a little firmer. We're positive by 0.1% from New York. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Equities a touch positive this morning, up 0.1% on the S&P 500. On the Nasdaq, we look a little something like this, positive by 0.1% on the Nasdaq. On the S&P 500, snapping a three-day losing streak in yesterday's session. The Russell up by 0.2%. No drama going into earnings. Two-year yields down for a third consecutive session. We're down by about 2 or 3 basis points. Your two-year right now, 4.83, just backing away. Think about it, 5.11 at the highs of Thursday's session and now down to 4.83. That's quite a swing in this bond market. The 10-year had got through 4%, breaks below it again. Tom, 395.81.
Well, you get a 5% above 505, I'm going to call it. And you go 5 and you take in 17, it's 22 basis points just coming back in the last couple of days. But to me, it's just sort of an ebbing before that key inflation report tomorrow. I don't want to make too much of it right now. The 10-year real yield, 1.71%, back about 9 basis points.
Elisa's favourite currency pair coming up, the euro against the dollar. Reclaiming 110, Bramo. There's a move for you. This is 4 consecutive days of euro strength. Longest streak going back to the middle of June.
And it's come on the heels of some persistent dollar weakness. I mean, it's been notable this week, which is interesting, given the fact that, yes, it has come in tandem with lower front-end yields just a touch over the past few sessions, but people are increasing their expectations for rate hikes. So this is the question. Fed speakers could have more hawkish tone, but the market isn't buying it over the longer term. They're not believing what the Fed is saying consistently, which is creating a little bit of an issue.
We were going to talk about a Federal Reserve and a bunch of Fed speakers, but I do think we have to move on. So let's do that and move on to what's developing in the UK. It's really interesting, Lisa, to see sterling cable. So this is the pound against the US dollar, just below 130 right now, 129.19, a higher this session. So a stronger pound. Tom, off the back of this wage growth data, which is just stubbornly persistent for the Bank of England specifically, because if you're receiving those pay rises, I'm not sure you want to give them up, even though the governor would like you to.
Well, this is really important. We've got the perfect guest for this right now. David Page joins us here, and we're really going to dive into this for our American audience, the absolute foreignness of what's going on in the United Kingdom. David, I want to go back to the University of York. I'm sure you staggered through Foundations of Economic History, ECO 24C. And somewhere in there was a Keynesian idea, I'm using that in a general sense, that the labor should sacrifice their wage gains for the good of the country. Is that a unique British aspect?
I think it's something that probably isn't even believed from the Bank of England or the Chancellor's perspective, although both sort of paid lip service to it at Mansion House speeches last night. But I think, what it does suggest is that we're getting a background here where, potentially the government is faced with the prospect of what it's going to set for public sector pay. There is a belief that it's going to ignore the recommendations of the Public Sector Pay Body Review and actually advocate something that's a little bit lower. So I think when they're advocating wage restraint, what they're doing is setting the backdrop for perhaps enforcing that restraint on the public sector. What we're not seeing from the UK at the moment is any signs of that restraint. There's a slight softening come through in the monthly numbers, but they're still too high for the Bank of England for now.
Lisa, it's 2023. It feels like a conversation from, I'm guessing off the top of my head, 1974. Yeah. Absolutely bizarre.
Or perhaps the Marie Antoinette times of let them eat cake. I mean,
back.
there's a question on it.
Like that period.
I mean, honestly, no one's really going to say,
like?
okay, I'm going to end up. What, you were there? Is that what was going on?
Yeah, it was good.
Is that what's going on?
I mean, the streets are muddy.
All right, moving on. I do wonder, David, if this is unrealistic and if what we end up getting is the Bank of England having to raise rates much more than they previously expected, raising into weakness. And perhaps this isn't what markets are expecting if the pound is gaining. How do you understand the market's response to what seems to be a necessity to hike into more weakness?
Well, I think you're seeing the opposite of what we're seeing from the US perspective, which you touched on previously. When the Fed is tightening now, markets are actually starting to trade the view, well, the higher they go in the short term, the more likely we are to see rate cuts coming through next year. And at the moment, that's just not the case for the UK. Markets are pricing an aggressive move from the Bank of England, not just at the next meeting, but going all the way through into early next year. And it's that sort of prolonged and staggered effect that is causing some concerns. Now, for sterling at the moment, that's great. Markets are looking at sort of 12-month interest rate differentials, particularly with the US, and that's helping to push cable up to these 130 levels. But the reality, I think, is probably very different, as you say. I mean, the Bank of England, had you asked them, and they almost said this about a year ago or just after the Liz Truss disaster, they pushed back against market expectations, which were lower than they currently are at the moment. Now, markets are once again testing that. Now, I think when we hear the Bank of England speak next in early August, they will again be pretty reticent to suggest that they're going to fulfill market expectations of rate hikes all the way up to 6.5. But they also had to hike rates by 50 basis points at the last meeting. We think because of concerns that inflation expectations are starting to pick up a little bit more as well. So clearly the bank has more work to do. That's what the labour market numbers are suggesting today. But I think the concerns that inflation expectations could be coming, unanchored and could therefore lead to persistent inflation in the UK is something that markets are sees the Bank of England have to raise rates for quite a considerable period of time.
Every economist who's come on this show has said, David, that the UK is unique, that the situation with inflation is very different from the one in the United States, where you are seeing disinflation come through in different sectors. How different is it at a time when wage growth is surprising to the upside in the US as well?
I would say not that different. I mean, the idiosyncrasies for the UK are obviously some of the things that have happened to labour supply, and particularly some uncertainties around immigration post-Brexit. There's also the sort of concerns around inactivity, given the difficulties with the NHS, which eased a little bit in the very latest month, but still is leading to quite a lot of inactivity. So there are some, idiosyncratic supply-side issues. But fundamentally, you've got a labour market that still looks too tight, even if there are some nascent signs that it's moving in the right direction, and that's creating wage growth. Now, of course, there are lags in the system, and from the Bank of England's perspective, those lags are probably extended relative to when they could last remember a tightening cycle. And that's reflected the sort of different composition of mortgage rates. So that complicates issues. But fundamentally, what we have is an economy that's been impacted by supply shocks, has then got a superheated labour market, more because of supply shocks than demand, but the Bank of England doesn't have the luxury of being able to distinguish, and therefore that's causing a risk of persistent inflation. That's the story that Jay Powell has been talking about for the last 12 months. It's the situation that the UK faces, but the timing is slightly different.
David, the mortgage market in the UK is so different relative to what we experience here in the United States. In the US, you have this beautiful option when rates are super low. You can lock them in for 30 years. Struggle to do that in the United Kingdom, David. Some of those mortgages are going to be up for remortgaging. And, David, I just wonder from your perspective, where in the time horizon that really starts to bite for people who have mortgages and ultimately, more broadly, for the UK economy?
So a number of factors there. I mean, I think it'll start to show up by the end of the year, and I think it'll be increasingly a story going further forwards as we go throughout 2023, and actually it'll take, throughout 2024 and then into 2025 as well for the full gambit to have remortgaged. Now, at the same time, mortgage holders are becoming less an important part of the economy. There are fewer homeowners, fewer of those homeowners actually own mortgages, so that maybe mitigates some of the effect. But there's also a big buy-to-let market in the UK now. So what's unclear is how much of these increases are going to feed through private landlords into increasing rents. So actually, you might see increases coming through in rents over and above what would have been expected beforehand. So what it means for the bank is, yeah, it's always been a very different market in terms of how it's coming through, certainly compared to the US. But for the Bank of England, it's also a very different market than they saw, say, before the GFC back in the sort of early 2000s. So this is some of the complication. They're having to gauge how much more the lags are, how much more extended the transmission mechanism is going to become, and therefore how much more they need to tighten before they start to see the effects of what's already gone through.
Well, David, let's build on that a little bit more. Torsten Slok of Apollo put out a piece last week on just how rate-sensitive the US economy was. He asked the question, why is it taking the Fed so long to slow down the economy? He made several points. Here are three. High savings in the household sector. During the pandemic, high yield and investment-grade corporates extended the maturity of their loans. He made that point about US households have 30-year fixed mortgages. They're less sensitive to Fed hikes. Just how sensitive is the UK economy to what the Bank of England is doing?
So more than the US, but less than it was. And I think some of those features that you refer to, and particularly the household saving issue, is also something that's come through here. We've also seen sort of different elements of fiscal stimulus. The pandemic created the fiscal stimulus that became the household excess savings on both sides of the Atlantic. More recently here, as we've seen very high energy prices particularly, the UK government chose to provide blanket fiscal stimulus to try and minimise some of the impacts of that high inflation itself on consumer spending, rather than targeting it. So in some ways, that fiscal stimulus offset some of the impact that was coming through from bank tightening. But I think that sort of level of buffer, both in the household sector and in the corporate sector, is also applicable, perhaps not to the same degree, but also applicable for the UK.
David, if we assume there's various and sundry disinflations, whether it's America, the US, whatever, which is the most efficacious disinflation? How do you have a good disinflation?
Well, I think the supply side improvements are the benign inflation. So we're seeing that coming through in energy. Of course, remembering the sort of lag structure of how this feeds through, energy feeds through very quickly to US inflation, primarily through gasoline. It's much slower to the UK market, primarily because we don't see the petrol price impact, but also because of the way it passes through to utility prices. So energy is the most benign of these issues. With energy prices coming off, that's a benign inflation. We'll also see a benign inflation coming through from the easing in global supply chain pressures, and that should be impacting consumer goods, and is to a large extent in the US, and will be doing more so in the UK. And equally, we should see some improvement coming through over the course of this year, El Nino permitting, with regards to food prices. So all of these are benign disinflations. The less benign are when you're having to crimp gains in the labour market so that we don't see pass-through to service sector inflation. And of course, that's what underpins core inflation, which is too high in the US and too high in the UK.
David Page of AXA Investment Management. David, appreciate it. Thank you, sir. On the latest in the UK and the United States, for that matter, just going back and forth with Guy Johnson, our colleague over in London, as this conversation was ongoing. Just going back to some numbers we were both discussing over the last week or so. This from the team here at Bloomberg, that at current interest rates, savers collectively earning 24 billion sterling more a year than compared to November 21. November 21 was right before, the month before they started hiking interest rates. Mortgage borrowers are paying 14 billion more in debt interest. So savers collectively earning 24 billion.
Yeah.
Borrowers are paying 14 billion. You can do the math on that. But Tom, there's a dimension of that analysis that we need to breathe some life into as well. Just an extra dimension. If you are a saver, you don't have that higher marginal propensity to spend in the same way someone that has a mortgage does. Yeah. So the translation into the UK economy, I don't think is as obvious.
Yeah, I agree totally with the idea of a marginal propensity. John, I did a work this morning on a mortgage, and if you had a 4% mortgage rate or a 7.31% mortgage rate, basically now with the same payment, you can buy 1/3 less.
Do you know what I do to torture myself?
1/3.
Bramo. Go on Street Easy, pick an apartment in New York City, okay, any apartment, and you can just go in and sort of re-enter what the mortgage rate would be and take it down from 7 and put it down to 2, and just work out what your monthly payment would have been if you'd got in a couple of years ago. This market is just radically different based on your monthly payment, what it would have been, Lisa, several years ago, and what it is now if you wanted to take a mortgage.
Which, to Tom's point, means that the housing prices, all things considered, have to come down in order to make people want to pay that exact monthly payment. That's the theory. But it doesn't work because there are no homes available for sale because no one wants to give up their 4% mortgage. And oh, by the way, suddenly people have tons of cash to spend because they're, saving, and then it didn't work that way.
Jonathan Miller, scheduled to be with us.
Oh, cool.
Today.
Looking forward to that.
He is the expert. He really has an understanding of the behavior going on in this dynamic.
It's just so odd, isn't it?
It's always, I've never been seen. It's odd as barely describes it. This is totally different than what I remember last time. It was 7-8% inflation. So totally
this is the reason why it's so hard to understand even the disinflation, because we don't understand how quickly housing prices are going to come down or rents are going to come down or if they will. And so any marginal declines, does that just set us up for other highs? And this, I think, is the tension in the U.S. as people say it's a very different story than what's going on elsewhere.
I think we're shaded by 3 zip codes. And of course, I haven't been below 59th Street in 2 years. But the bottom line is nationwide, rents are coming down.
The used car prices are coming down.
Exactly.
Yeah. The amount of EVs on the lot. Some reporting from Axios yesterday. Some interesting stuff there. Equity futures just about positive on the S&P. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Fenway Sports Group has become a $10 billion global powerhouse. CFO Julie Swinehart tells Tom Keene how she's helping the company raise its game.
Winning's at the core of everything we do here, and the balance sheet is so important to the success of the team.
Watch Chief Future Officer Wednesday on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
These changes would increase capital requirements overall, but I want to emphasize that they would principally raise capital requirements for the largest, most complex banks. We intend to consider comments carefully, and any changes would be implemented with appropriate phase-ins.
Michael Barr there, the Fed Vice Chair for Supervision, speaking on bank regulation ahead of earnings season. Earnings season kicking off on Friday with JP Morgan, Citi and Wells Fargo. Then through to next week, Bank of America, Morgan Stanley on the 18th, Goldman Sachs, Tom, on July 19th.
What are we going to look for there? I'm not sure. I mean, they're all different entities. I get that, but I guess we're going to look at some of the dynamics of J.P. Morgan and other troubles on the balance sheet of that. But the basic tone I get in the zeitgeist, listening to Joe Weisenthal particularly, is Wall Street, Goldman Sachs, Wall Street, Morgan Stanley, Wall Street.
Struggle.
It's a struggle, to say the least.
Hear the same thing.
I really wonder what we're going to hear.
Lisa?
I just am looking at the idea that suddenly Michael Barr wants to raise the capital requirements on big banks said nothing about the supervision function of the Federal Reserve and how to bolster that, said nothing about the regional banks, which really were the problem in the previous iteration. So how do we get this to translate into a very delicate political dance for the executives? Yeah, JB Diamond hasn't really been talking, but you can imagine behind the scenes, he's just saying, are you kidding me? This isn't going to do anything.
No, I think you're dead on, and that's the key question is what are we trying to accomplish here? Someone expert at this, we're going to get a brief on this. This is serious for Global Wall Street. Maya Rodriguez-Valadares joins us now, Managing Principal, MRV Associates, and really expert on Basel III, Dodd-Frank, and the rest. Myra, I'm lost. We had Basel III, we had Dodd-Frank, and that had basically nothing to do with helping us with the SVB disaster. How do we regulate, or as Lisa says, supervise improvement so there isn't another SVB?
The critical thing to remember here is that there were some very important components, both in Basel III and in Dodd-Frank, that were removed for banks the size of Silicon Valley Bank, Signature, and First Republic. So under the Trump administration, a law was passed, the Economic Growth, Regulatory Relief, Consumer Protection Act, and that stated in Title IV that those banks that were under $250 billion were not systemically important. So there were a lot of very good provisions in Dodd-Frank and Basel III that would have applied to those banks, and that unfortunately was revoked. But you correctly pointed out very key words here: regulation and supervision. What really needs to happen here is that there need to be more resources and more attention dedicated to what exactly is going on in the examination process at the Federal Reserve Bank especially, but also the OCC and the FDIC.
Okay. But Myra, the thing that I don't understand here is after what we all went through 6 months ago, 5 months ago, let's just fix it. Is there any thrust to bring back the original Basel III and Dodd-Frank?
Well, Basel III has long existed, and the United States is very much a part of the Basel Committee on Banking Supervision. So the U.S. always opines on all these rules. And so there have been additional tightening recommendations over in the Basel Committee, and that's what people now refer to at the end game. The big banks were being allowed to use models to measure their credit risk, and so they had way too much flexibility to do that. So there are some good things that that Barr is recommending. What I am concerned about is that indeed we need to hear specifics about what's going to happen with improvement on the regional banks. Those are the ones that again need to be designated as domestically systemically important, as they were under Dodd-Frank Title I. That part was revoked under the Trump administration. And we also need to hear specifically about supervision. How will the bank examiners really be empowered to do their job? If you read those documents that were released, the original documents that were released with the Barr report, those are, to me, much more interesting than the Barr report itself, respectfully, because you see there the comments from the examiners. They did their job. The question is, was there middle management intervention? Right. Was there senior management intervention? We haven't heard that yet. There needs to be an independent investigation of what happened there.
Myra, there are a lot of questions, and we know what they are. A lot of people have been asking them for the past few months. What we heard from Michael Barr was not that yesterday. And just to sort of distill what you're saying, is this essentially a fig leaf over the issues of banking supervision, as well as whether you're going to increase regulatory capital for some of the smaller banks, a political hot potato that no one wants to address, instead of focusing on some of these hard questions that may yield some very uncomfortable answers?
I think, unfortunately, this is a situation where you have to do both things at the same time. And that, of course, can be quite challenging. First, Basel III endgame, in other words, those revisions have been ongoing. Those discussions happened way before Silicon Valley Bank. So that's really what Michael Barr focused on yesterday. And yes, of course, we need resilient, globally systemically important banks. However, the next step really has to be focusing on the regional banks, and it has to be focusing on supervision. How are you really going to empower that whatever the bank examiners find, that actually makes it all the way to the top. And if banks are not liquid, that's the real issue here. SVB, First Signature, they were not liquid.
Yeah.
We also have to remember that no matter how much Dodd-Frank or Basel III you have, that is not going to prevent bad behavior at some of these banks. Look at Wells Fargo right now. Predatory lending practices against African Americans and against Latinos. You can strengthen capital all you want, and that bad behavior is not going to be addressed. So you still have to deal with remuneration of the executives. You can't have a situation where you have an SVB CEO that is very much part of the implosion of that bank and then runs off to Hawaii with his bonus.
Lisa, to me, the whole thing here is just as simple as this. We all saw the crisis that we lived. None of this helped protect us from that crisis. Nothing. Basel this. Have I read Basel III?
Well, a lot of the new requirements.
1,000 pages?
A lot of the new requirements came out after 2008, and some of them didn't apply to the regional banks. This, though, is the key question, Myra. Is it over? Have we seen the end of the turmoil that we saw in March? Was it sort of a one-off with a select number of firms?
I don't think so, unfortunately, because even though the Fed has temporarily paused, we're still at very elevated interest rates, which means high cost of borrowing for these regional banks. You still have inflationary pressures in the UK and continental Europe. So those central banks have raised rates more recently. And so you do have those trouble spots ahead. You're having rising default rates in credit card area, auto loans, commercial real estate. And I think we're going to see some of that this coming Friday with bank earnings. All the big banks, including JP Morgan, all raised their loan loss provisions last quarter. So they knew that there were these, troubling times ahead. And so I think, unfortunately, the regional banks are going to be the ones that will bear the brunt of rising defaults, especially in the commercial real estate area, because their portfolios allocated to commercial real estate percentage-wise are larger than a JP Morgan, a Bank of America, and those banks are much more diversified. Tom, you mentioned earlier Goldman Sachs and Morgan Stanley. We have to remember that those essentially are still primarily investment banks, securities firms, so they don't benefit from the business line diversity that JP Morgan and Bank of America have. They have asset management, they have the actual bank entities. So these rising default rates are going to impact everybody, but I think that you're going to see the volatility in the market, and that's going to hurt those banks that are less diversified than a JP Morgan. And so that, unfortunately, that means Goldman Sachs, Morgan Stanley, and then you have the regional banks that don't have the asset management, investment banking, et cetera, again, than those largest globally systemically important banks, including Citibank.
Looking to see how that develops on Friday. Myra, we've got to leave it there. Myra Rodriguez Valladares there of MRV Associates on the latest with the banks. What are three things we've got to do today? Push ahead to bank earnings on Friday, push ahead to the economic data. That really kicks off tomorrow, and provide you some coverage of this NATO summit over in Lithuania as well. Over the next couple of hours, we'll catch up with Maria Tadeo and Bloomberg's AMA Chammarie just around the corner. We'll catch up with her in about 20 minutes' time. The president of Ukraine, Zelensky, out on Twitter in the last hour. I have to say, he doesn't sound too happy, TK, at all. It seems there is no readiness neither to invite Ukraine to NATO nor to make it a member of the alliance. Uncertainty is weakness, he says.
It's complex, and the key complexity to me is Erdogan. The surprise of the last 48 hours is the Erdogan response to Sweden.
That's coming up next in the next hour on Bloomberg TV and radio. Up next on this program as well, Phil Camporelli of JP Morgan Asset Management from New York. This is Bloomberg.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From business's most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
I don't feel like the market's been crazy. I do see the potential for some upside.
The markets are being very rational.
Investors have been investing in a new regime from the last 10 years.
Maybe the Fed's not fighting as big of an inflation problem as we thought just 90 days ago.
As we're heading into the end of the year, we do think things start to slow down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Welcome to 2023, where the narrative changes every week. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market this Tuesday morning, slightly positive by 0.1% on the S&P 500. A NATO summit underway, Tom, in Lithuania.
Yeah, and this was going to be, well, we didn't know what it's going to be, but we thought it would be, okay. But all of a sudden, this is a big deal. Maria Tadeo and Marie Horton are there as well with important conversations. We heard from the President of the United States. And it's a stew right now, John. I mean, there's no other way to put it. From Ankara and Turkey all the way up to Sweden, there's a lot of movable parts going on in the next 12 hours.
Let's go through that, Stu. A couple of points here, Bramo, as we anticipated this meeting. Sweden's participation, becoming a member of NATO, gaining the support of Turkey. It's a scratch my back, I scratch yours. Here's some F-16 story, perhaps. Then you've got this provision of some munitions that are incredibly controversial. The president supports them, others in NATO do not. And on top of that, this pathway for Ukraine to become a member of NATO. That's highly, highly controversial.
It highlights how the conversation has evolved 18 months after the inception of this war in Ukraine, as it drags on a question around how united NATO members are and what the exogenous risks are to crossing any potential red lines that we don't understand in terms of involving NATO members in a broader conflict.
Yeah, but the heart of the matter is if Ukraine joins NATO, which goes back to Bucharest and Condoleezza Rice and Robert Gates, that was, from my amateur read, that was the tip point for Mr. Putin. What does he think here? Finland, NATO, Sweden, very close to NATO, and now there's active discussion of Ukraine at NATO. Putin has to be borderline hysterical.
Everything he didn't want is happening, Tom.
Exactly.
We talked about this in the last hour, the absence of a conversation about a pathway to peace. No discussion about it whatsoever. And this war, Lisa, going on for much, much longer than people thought it would.
And is there less pressure on ending it because we haven't seen the inflationary boost that people expected? There hasn't been the economic hit. I was just reading a story about how stockpiles of natural gas in Europe are at the highest levels in a long time heading into winter. So this doesn't seem to be a problem. Does the lack of economic incentive reduce some of the pressure to draw an end to this in a way that seems very murky at a time of so much complexity and a rogue nation?
In the blur of it, when my eyes glaze over, and they do, to be honest, what captures my attention is when they talk about Crimea. And I wonder how Zelensky will deal